your position, and I'll try to see.
Let's not waste any time and get started. So the very first thing you want to do is set up a TradingView account. So if we go ahead and type in TradingView, it should pop up. And here on the top right, you want to click on Get Started. Now, TradingView is completely free to sign up, but you do want to go ahead and scroll down and buy this essential subscription plan because it's going to save you in the long run. It comes with 2 charts per tab, 5 indicators per chart, 10K historical bars. You have the ability to have the bar replay. So when you're back testing on the weekends, you have the volume profile, and then you have your custom timeframes. Now, although that is very helpful, it really is up to you, but I would recommend it. Once you click sign up, you're going to go ahead and use your Gmail or email or whatever that may be. It should take no longer than 2 minutes. And once you're done, you now have a TradingView account. Once we have an account set up, you want to go ahead and click on markets at the top. Click on any pair and click on see super charts on the far right. You should now have access to the full TradingView market. Now, in order to add pairs, you want to come to the far right and click on this icon, and all of your symbols should pop up. These are my default symbols. So I have gold, NASDAQ, S&P 500, and then I have the micro pairs. Now, if you want to have your chart set up like this with the blue and white, I will go ahead and give you my settings. But for the majority of this course, I believe it's going to stay on the default red and green candlesticks. So here are my settings. I have the body, the wick, the background, the status line should be default. The scales and lines should be default. Canvas, I have the solid background. I don't have any grid lines. My text font is 12 and my lines are black. Trading should be default. Alerts should be default, and events should be default. All right, so for this next part, I want to go ahead and talk about how to find your futures contracts. So we're going to go ahead and bookmark another website called cmegroup.com. This is the website that gives me all the information about futures and other market data that I need. So once this website loads, what we're going to do is go ahead and find the search bar and type in contract months. Once it loads, you want to go ahead and click on contract month codes. And you want to go ahead and memorize these monthly codes. So January is F, February is G, March is H, April is J, May is K, June is M, July is N, August is Q, September is U, October is V, November is X, and December is Z. Going back on TradingView, if you look at the rest of my symbols, notice how they're all relevant to this month. So we have NQ, which is the symbol, M, which means we're in the month of June 2025. We have ESM 2025, MNQ M 2025. Another way to figure out which futures contract is active is if we go back on the website, go to markets. Let's say we're trading gold. We'll click on GC. Click on gold futures. Find where it says volume and OI. And if we scroll down, we want to try to find the column with the most trading volume. So notice over here, we have the highest number and the total volume. And notice how it's in the column of June 2025. And the monthly code for June is M, which is why we have that letter next to GC. And TradingView does a really good job of organizing these monthly contracts. If we actually go on the plus sign and find a random pair like S&P 500 and click on the arrow, it will show you all the pairs that are listed. We have ESM, U, Z, H 2026. So just find the monthly code that is relevant to that contract and you should be good. So once all of that is set up and you have all of your pairs that you want to trade on your watch list, the next thing you want to do is set yourself up with a broker. So back on TradingView, if we come down to this arrow below UTC, you'll be given a general pool of brokers to choose from. Now, this part is really up to your own disclosure with the broker you choose after doing some thorough research. But the broker I'm set up with myself is Tradovate, and I actually have it set up on my desktop over there. But essentially, what you want to do is create an account like you did for TradingView. It's very simple and it's going to walk you through all the steps. And once you have an account set up, you want to go ahead and click on Tradovate, click on live, depending if you have a demo or live account set up, and connect. And once you have that connected, you'll be able to trade directly from TradingView through your broker's terminal on Tradovate or whatever that broker that you choose from. Everything else in this video should help you get a solid understanding on day trading and how to day trade on a daily or weekly basis, starting from candlesticks all the way down to smart money concepts. I'll see you guys at the end. So in the market, there are two types of candlesticks. You have your bullish candlesticks and you have your bearish candlesticks. So for a bullish candle, you have to open at the bottom and the close at the top. For a bearish candle, you have your open at the top and you have your close at the bottom. At the end of these candlesticks, sometimes they will print thin lines, which we call wicks. I don't really see a lot of traders call them shadows. You can if you want, but for now, we're just gonna stick with wicks. And then of course you have your high and you have your low. Okay, so first let's look at some bullish candlestick patterns. We're gonna go ahead and ignore a few of these candlesticks because they're not really accurate or they're not as important as the most simple ones that you'll see over and over again. So let's start with the bullish engulfing. So the bullish engulfing is pretty self-explanatory. It's simply when a bullish candlestick is engulfing the previous one. So in this example, we have a bearish candle and then the next one is engulfing the previous one. So this is why we call it a bullish engulfing, because the bullish one is engulfing the previous bearish one. Okay. Now, if we open up TradingView and try to spot that pattern, you can oftentimes see it when we have an uptrend channel. For example, I'm currently on Euro USD. If we go on the daily time frame, we can see that price is pushing up. So let me go ahead and scale down on the 2 hours so I can see these patterns more clearly. And let's try to find the bullish engulfing. So boom, right here, we have price moving up from a previous range or level of support. And if we look for a bullish engulfing, we can spot one right here. Notice how we have this nice bearish candle, and the next open is a nice bullish candle that engulfs the previous one. And what does price do? It continues to push up. Now, I want to make something extremely clear. When you are using candlestick patterns, you don't want to trade off of candlestick patterns alone. What these are confluences that support a bias. And we're going to go ahead and cover confluences later throughout the series. But I want you guys to keep in mind that candlestick patterns are not the sole indicator to enter in on a trade, because I don't want you guys to watch this video and start hopping in trades off of one candlestick pattern, okay? But just keep in mind that they help support a confirmation that you're about to take for a trade, whether if it's a buy or a sell, okay? So boom, we're able to spot a bullish engulfing. Now, let's try to find a bearish engulfing. What is a bearish engulfing? Well, if a bullish engulfing is a candle that engulfs the previous one for a bull run, a bearish engulfing is when a candlestick engulfs the previous one for a bear run, okay? Or a bearish run, excuse me. So right here, before we have price move up, price eventually has to come down first. So if we come to this area on Euro USD right here, we can see that price has a nice bearish engulfing before it pushes down. Now, it's not perfect, but you can clearly see that this candlestick has more momentum than the previous one, okay? So in this instance, this would be a bearish engulfing. Even right here, we have another bullish engulfing before we have that nice push, and then price opens above that newly formed support. Let's see if we can find one more. And boom, here's another example of why you shouldn't trade off of candlestick patterns alone. So this is a bearish engulfing, but look at what price does. It does open below just a bit, and then it wicks off and pushes back up. So in this instance, if you traded off of this bearish engulfing alone, you would have lost this trade because price doesn't continue down, it pushes up. So that's just something to keep in mind. All right, next we have piercing line, not important. Bullish harami, not important. Tweezer bottom. Yeah, okay. I like this one. So tweezer bottoms are great to identify when you are predicting price of a trend to reverse. So if you're in a downtrend market and you think price is going to reverse at a pivotal point of support, then you want to try to find these tweezer bottoms that will hold some sort of confluence saying, hey, I think price is about to start pushing up. So if we go back to trading view, let's go ahead and use GBP USD. Tweezer tops or tweezer bottoms are usually found at a grand area of support or resistance where price is in some sort of indecision or price is going to continue to range. What do I mean by that? Well, if we go ahead and look over here, notice how we have this gap in the market and then price comes back down and pushes up. Well, if we go ahead and get our horizontal ray and mark this up, I guarantee we'll be able to find some sort of tweezer top or bottom saying that, hey, we're at this nice level of support. I'm not really quite sure if I want to start a downtrend market. So I'm going to respect this level and push back up. I really like the 1 hour, but for now, we're just going to stay on the 30-minute time frame. And if we look at this level of support, we'll be able to find some sort of pattern. So I went ahead and went to the 1 hour because I wasn't really seeing anything on the 30-minute. And boom, right here. So notice how price does come through this line of support, but it doesn't close below, meaning price wasn't fully committed. It respected that level and then pushed back up. And this tweezer top right here can be used as some sort of confluence saying that, hey, price wasn't fully able to commit or close below. So instead, it formed a tweezer bottom, pushing price back up into this range. So the next candlestick pattern we're going to talk about is the morning star. And we're going to go ahead and skip the hammer, inverted hammer, any candlestick that is represented as a doji, aka wick. We're going to talk about at the very end because wicks play a very vital role in the market that I want to talk about and cover at the end. But for now, we're just going to talk about the body of candlesticks, the candlestick patterns that are more often and frequent that you'll come across, which is the bullish engulfing, tweezer bottom, morning star, and then obviously the twin of that candlestick pattern when we talk about bearish candlesticks. So for a morning star, you'll usually see these candlestick patterns print at the very end of a bearish trend. What does this mean? Well, this pattern signifies that the trend is getting ready to reverse. So at the end of a bearish trend, if you're at a vital level of support or you're at a clear zone of demand, more than quite often, you'll see this pattern print. So we pull up TradingView and let's go on gold this time. And let's try to identify some sort of a bearish run. So we have this area on the 2 hour. Let's go ahead and highlight real quick. And let's go ahead and scale in on the 1 hour. And let's go ahead and zoom in at this pivotal point before the market reverses. So if we come down here, we can see that this morning star is printed at around this area. Now, is it perfect? No, but you can clearly see that we have a longer push, right? Going back to the chart, and then we have a candlestick getting settled at that area of support, right? If we get a horizontal ray and place it right here, and then the next open takes out this high or the previous high of this candle. We see on the chart, the next open takes out that previous high of that bearish candle. So what does this mean? Well, if we go back on TradingView, I keep on clicking the candlestick Bible, I apologize. If we go back on TradingView, notice how we have this print and what does the market do? Consolidates for a little bit and then pushes up, taking out all of these candles. So oftentimes you'll see this pattern in print at the end of a bearish run. Is it the biggest bearish run? No, but like every candlestick pattern, you want to use these as a confluence that guide you on confirming an entry for a trade for a sell or a buy. The reason why it's called a morning star, because if you think about the morning, the sun comes up, right? After nighttime, the sun eventually comes back up, and then vice versa for the bearish candlestick pattern, we call it a evening star because you'll see these patterns print at the end of a bullish trend, meaning that the market is getting ready to reverse for a downtrend market. So morning star, looking for buys, evening star, looking for sells. And I believe these patterns are also in the candlestick Bible. Yeah, right here, page 31, we have the evening star candlestick pattern. And then we have the morning star, which is the previous chapter. So pages 28 and 31, you should find that there. And again, just practice, pull up TradingView, just back test or try to find an area where you see the market pulling down. And then at the very end, before it starts to reverse, Try to identify a morning star for a bearish market and a evening star for a bullish market. Okay. Those, in my opinion, are the most important or more frequent candlestick patterns you'll see at a convenient area that you're trading. But I want to take some time to talk about wicks, the dojis, right? So when you see wicks in the market, when the wick is engulfing the body of the candlestick, that simply means that price is in indecision. So whenever you see a long wick after a bullish market, right? Again, we have the buyers and the sellers. So let's say the sellers are pushing the market down, or did I say bullish trend? We'll start bullish and then we'll go bearish. For a bullish trend, let's say the buyers are pushing the market up, and then the next candlestick is a long wick for the top and a short body for the bottom. So that long wick, let's see if I can find an example as I'm explaining this. Okay, boom, perfect. This is on gold. Perfect. Let me full screen this. So this long wick right here, this is beautiful. And this is considered as an evening star, 3 candles. This is beautiful. So this long bearish wick right here represents that the buyers are losing momentum. The buyers are no longer in control, right? We have a lot of momentum. We have these nice chunky bullish candles. And then on the next open, we have a bearish candle with a small body and a long wick, meaning that at some point in time, the buyers lost momentum. So these wicks that you'll usually see print at the end of a trend means that the sellers or buyers are now in control. And then we have a nice bearish push, and then the market is now doing its thing. And this is where gold is currently at. We don't have any more data to see if it's going to start pushing down, but I'll keep this updated for the future videos. But again, notice how we have an evening star, which is beautiful, which signals that the market may be ready to push down. There are other reasons why wicks may print at vital zones of support, resistance, or supply and demand, which we're going to talk about later, because that had to do with the concept of liquidity and orders. But I'm going to save all that for later because it does tend to get kind of complicated. So we're going to keep it very simple and sweet to the point as we work our way up through this series. This is going to be the basics. I want to cover 3 categories in this video. We have pips, support and resistance, and the 4 different types of markets. I do recommend you guys take some notes in this video with the things I have written on the screen. If not, you can always come back to this video for review. But before we talk about any advanced stuff, I thought I'd cover some basic information just in case you're a newbie or you're very new to the industry. You have no idea what these things are that I have on the screen listed. I want to make sure you guys are good to go with no questions asked. So starting out with pips. What is pips? Every now and then you'll go on Instagram or you'll watch some live stream of a trader that will say pips. So in the trading industry, we use this term to identify the movement of price. Think of it like inches, centimeters, yards, millimeters. For day trading, pips is our measurement. So if we go on Euro USD and we want to identify how many pips a candlestick moved, let's say we're trying to identify how many pips this candle right here moved. I'll go ahead and highlight it so you guys know exactly what I'm talking about. We're simply going to grab our price range tool that we have, start from the bottom of that candlestick, go all the way to the top. And on the far right, it gives you the amount of pips price moved, which is 10. And this is why this tool is so useful, because if you're having a hard time identifying how many pips price moved, you can simply whip out this bad boy and it will tell you. Alrighty, next we have our lot sizes. So within trading, we have our lot sizes, which determines how much money we're going to make or lose in a trade. So I had my brother ask me recently, who's starting out trading, how much money can people make with day trading? And I had to sit down and really think about that question, because although it's very simple, it's complex in a way for each individual. I think there's a misconception that trading is divided equally for every person. The amount of money I can make in one day is the same amount of money someone else can make another day, right? Although there is a little truth in that. Yes, you can make the same amount of money as I can make every day. It's not realistic, because I use lot sizes dependent on whatever capital I have in my trading account, right? If you're starting out with $100 or even $10, your return on investments or the amount of money you can make is different from someone that's starting out with 1K or 10K or even 100K, right? It all depends on what capital you're starting out with and the lot size you use for each trade. So within trading, we have three lot sizes that are divided for every trade that you take. You have your micro, you have your mini, and you have your standard. And I have some PDFs right here to the side that we can look at. Um, this does say nano, but we're not going to focus on that because nano is for penny trading, which is 1 penny per pip. We're not going to focus on that, but we're going to go back to TradingView and talk about it. So a micro lot size is 10 cents per pip. A mini lot size is $1 per pip. Let me actually write that down. I'll just do like a arrow, I guess. So we have a micro lot size, which is 10 cents per pip. We have a mini lot size, which is $1 per pip. And then we have a standard lot size, which is $10 per pip. Now, within every lot size, it scales all the way up to 10. What do I mean by that? Well, you don't have to be limited to a 0.01 lot. For a micro lot size, you can use a 0.02, a 0.03, all the way up to a 0.09 until eventually this micro lot turns into a mini because that next number would be 0.1, right? Or 10. So let's say in the same example, we caught 10 pips, but used a 0.02 lot size. Well, how much money did we make in that trade? If you said $2, you were correct. Why? Because if we get our calculator and do 0.02 times 10, we come out with $2. Now you might be telling yourself, wow, $1, $2, lame. I don't want to make that low amount of money. But sometimes when you have a small account, you're going to want to stick with a compound plan to build up your account eventually to use higher lot sizes. Because let's say if you started out with a $100 account and you used a standard lot size, which is $10 per pip, well, that 10 pips that you make in a standard lot can either make you or break you because you could win $100, but also lose $100, which would blow your account. And we're going to talk more about that later throughout the course when we talk about risk management and the lot sizes you should be using, how to have a compound plan so that you never blow your account. But let's go ahead and move on. Alrighty, so next we have our mini lot sizes. And our mini lot size, if we go to the PDF, is simply $1 per pip. And I actually want to show you guys this one because this PDF is pretty complex. We're not going to talk about units of base currency or nanolots because a nanolot is literally a penny per pip. And let's be honest, we're not over here to make pennies. We're trying to make those big bucks, right? So we're going to ignore this PDF and look at this one because we have our micro, which is 10 cents per pip. We have our mini lot size, which is $1 per pip. And then we have our standard. A mini lot size, in my opinion, is the most basic format of a lot size because it's literally $1 per pip. So if you catch 9 pips, that's $9, 10 pips, $10, 20 pips, $20. But it all depends on that multiplier that you're using. What do I mean? Well, just like a micro lot size, the multiplier goes all the way up to 10, aka standard. So we have 0.2, right? We have 0.3, we have 0.5, all the way up to 10, right? So for example, if we caught 40 pips using a micro lot size, that base number of 1 would make us $40. Why? Because if we get our calculator and do $1.00 times 40, that would leave us a profit of $40. But let's say you want to use a different multiplier. Let's say we caught 40 pips, but you use a 0.3 lot size. Well, if the base profit of a mini lot size would grant us $40, all we would simply do is multiply that number by 3. So instead of 40, we're multiplying that by 3, which would give us $120 because 40 times 3 is 120. Let's say we caught 9 pips and used a 0.5 lot size. Well, if the base profit would have given us $9, but we're using a multiplier of 5, we would have received $45 in that trade. Why? Because 5.0 times 9 is 45. Makes sense? If not, go back, review what I just said, practice, and we will move on. But real quick, I want to throw out a disclaimer. You guys don't have to be math wizards to be good at trading. This is the only point of time where you'll have to do the most math. There's this whole misconception that you got to be an A-level master math wizard. Math is my worst subject, right? As long as you have a calculator, you can do simple math of multiplication, you should be good. This is all the math that you'll be doing when you turn into a day trader, okay? All right, moving on, we have our standard lot sizes. So the standard lot size, which is 1.0, equals $10 per pip. And then on the spreadsheet, we have it right here, right? So $10 per pip, what does that mean? Well, let's say we caught 10 pips in a trade and we use the base number of 1, we would have made $100 in that trade. And just like these other lot sizes, we have multipliers that go all the way up to 10. So we have 1.0, 2.0, 7.0, all the way up to 10. Okay. So let's go ahead and throw out an example real quick. Let's say we caught a trade of 50 pips, right? Well, if we use the base number of that lot size, which is 1.0, we would have made $500. In the calculator, you're doing 10.0 times 50, which is 500. Just like all these other lot sizes, it all depends on what multiplier you use. So let's say we use a standard lot size of 3.0. Well, if we caught 50 pips, we're multiplying that base profit by 3. So instead of $50, we would have made 150 because 50 times 3 is 150. Now, I know this sounds pretty sweet, making the amount of money that you can with these lot sizes, but you have to be careful because the same amount of money you can make is also the same amount of money you can lose. All right, moving on to the next part, we have support and resistance. Let's go ahead and just come up here. All right, so when we talk about support and resistance, this is a phrase you will hear over and over again, mainly by retail traders that are able to identify levels in the market, whether if we're in a uptrend, downtrend, range, or choppy market, which we will talk about in a minute. But your support is basically the base of which price is above, and your resistance is that ceiling at which price is below. So I have the definition right here if you want it down. Support equals a price level at which a currency pair tends to find buying interest as it declines, and resistance is a price level at which a currency pair tends to find selling interest as it rises. So in simple terms, when price is at a level of support, there is a interest for buying. When price is at a level of resistance, there's a interest for selling. Okay. And let's just draw some out real quick. So let's say we're in a trend like this and we want to try to identify where our support is. Well, if we just pass through this range, our support or newly formed support would be this line right here, and our resistance would be right here. One thing to keep in mind is that your support and resistance will change throughout the day or trading period dependent on where price is at. So let's say price decides to break through this level throughout the day and pushes up and makes another retracement. Well, now that we broke through this range, we can identify this as our newly formed support in this level right here as our newly formed resistance, just like that. Why? Because price broke structure. Now, if price decides to push back down to this range, this would be our old resistance, and this would be our old support or new support if price decides to push up right here. So it all depends on where price is at, okay? So let's go on Euro USD real quick and just practice. Let's go on the daily time frame and just scroll some to the left. Let's go in right here, go on the 2 hour. All right, boom. Let's say we're looking at this area right here, okay? Go and scale it. And we're looking for support and resistance. So my support is the area at which price is surfacing for a lot of buying interest. Well, if we look at this area over here, I'm noticing that we're having a lot of touches to the downside at around 1.08585. So off jump, I'm going to get my horizontal ray, place a line, and I just want to see and ask myself if this makes sense. Do we have a lot of touches? Is price respecting this level? And as you can see, we have this break, we We have this touch right here. We have this touch right here. We also have a touch right here. And then price finally breaks. And then we come back eventually, and it does kind of make its way back up to that newly formed resistance, but we don't quite make it there in time. These levels don't have to be perfect. Notice how I just pushed it down a little bit to make it more clearly visual to you guys. You just have to be able to identify what price is doing, okay? So this would be my support. And let's say we're looking for resistance at this level as well. I'd probably place it right here. So my support would be right here. Resistance would be right here. Now, eventually, what does price do? We have this break of structure and eventually pushes back up to that newly formed resistance. Why? Because we had our old resistance in this range before price decided to push down. And then our newly formed support would be at around this area right here. Just like that. And this was a Friday, and during the weekend, the market does close. And when it opens back up on the next week, sometimes markets form gaps like this. So we had the open on Monday, price decided to do its thing. We had a push back up to this range, support resistance. And we had another push where we can identify new levels of support. So this would be our newly formed support level. This would be our newly formed resistance. Price does its thing, pushes back down over here. And you're just kind of trailing price with levels of support and resistance. Notice how it all makes sense visually. Later down the road, we have a touch right here. It respects this level. It respects this level. So one thing that you guys will notice with support and resistance, it respects price, you know, the history of price, which we're going to talk about in a minute, because within support and resistance, there are three types of levels. You have your historical levels, you have your psychological levels, and you have your technical levels. Your historical levels are levels that respect previous price, the history of price, right? So notice that we had a lot of history on Euro USD. I'm sorry, was it GU? I can't remember what pair we were on, but we had history, which is why price respected that level. So this is why sometimes you'll see traders keep their lines on their charts, not because they're trying to overcomplicate their trading view. It's because they're trying to identify some sort of historical level that price might respect for a long period of time or a longer period of time, right? Next, we have our psychological levels. So your psychological levels aren't as important in my opinion because these are based off of round numbers. And the last one is technical levels. Your technical levels are based off of indicators. One specific indicator is the Fibonacci retracement, which we'll talk about later this week. But your technical levels are really just relevant to your technical analysis if there are several confluences, okay? So I want you guys to study this, practice with support and resistance. What I want you to do for homework is literally pop up any currency pair, and for the first 2 minutes, try to line up levels of support and resistance and see throughout the time of the day if it respects that level. Within trading, you have 4 different market conditions. You have your uptrend, you have your downtrend, you have your range, and then you have the choppy market. So your uptrend market, pretty obvious, is when price is moving up, right? And if we go to this PDF, your uptrend market is identified by higher highs and higher lows. So if we go back on our chart, when you can identify price making a higher high from the previous one and making higher lows from the previous low, you can say we're in an uptrend market. And then back to the previous lesson, our support would be right here. Our resistance would be right here until price eventually breaks structure, making this our newly formed resistance and making this our newly formed support. Okay. So a downtrend market is the opposite. This is what it looks like. So we have a lower high and we have a lower low. Okay. And lower lows. Okay. And then if we're using support and resistance, this would be our resistance. This would be our support until we break structure. This would be our newly formed support. And this would be our newly formed resistance. Okay. Just like that. Now, our range is a bit different. So your range is when price decides to respect structure at those given lines of support and resistance for a long period of time. So if we have an uptrend market and it decides to push back down for a little bit and then respect this level, like that, come back down, and then come up. Maybe it has a wick right here, comes back down, comes back up. Price is not breaking any sort of structure. So since price is in a side channel, respecting these levels of support and resistance, we call this a ranging market until eventually it decides to push to the upside, forming some new structure for maybe an uptrend market, or if eventually it decides to push down and have a breakout to the flip side. Why is this important? Well, if you notice that price is ranging for a long period of time, or if it's at the start of a range and price decides to get close to a level of support, you could just be in time to enter in for a nice buy. Vice versa, if price is at the beginning of a range and it's nearing resistance, you could enter in at a nice point for a sell. So if price was right here, catch a nice sell to the flip side. If price was right here, catch a nice buy to the upside. So what exactly does this look like? Let's just go to a random pair. Let's type in Euro JPY. Let's do Euro JPY. If we go to Euro JPY and we go to a random point in the market, let's just scroll all the way over here. Make sure all this is gone. Let's just go over here, okay, to this area. I'm noticing that price is moving up on the daily time frame. We would identify this as an uptrend market based off of structure. So notice that price is making higher highs and higher lows, right? And if we add in support and resistance, notice that it does respect these levels. So we have our higher high from this high, and we have our higher low from the previous one. When you have strong structure like this, it gives you more confidence to see the market for what it is. With more confidence comes execution. With more execution comes more money or more trades, depending if you win or lose, right? And the reason why I emphasize structure so much is because it helps you identify at what point in the market will it might respect a level or reject a level. Okay. But what does a range look like? I think I had an example on GU earlier when we talked about structure. Let's see if I can find it again. Was on the daily time frame, or did we use Euro? It was on Euro USD. So on Euro USD, we come over here, we have a ranging market in this range. Why? Because if we scale out on the 2-hour, notice how price respects this zone for some time before eventually having that breakout. So price isn't quite in an uptrend market or a downtrend market because we don't have structure of higher highs and higher lows or lower highs and lower lows. So we would call this a range until price decides to eventually break out to the upside and trail up. Now, if it's difficult to identify a range, if it's kind of hard to draw in your support and resistance levels, in this case, it's 50-50 because on the bottom, it does look pretty clean. We have a touch right here, a touch right here, and we have a touch right here, which it respects. But on the upside, it's a bit sloppy. Sometimes you just want to stay away from it because it's going to confuse you. But if you can identify strong levels of support and resistance and stick to it, you can say it's a ranging market. Here's a more clear example from past data. If you guys want to look at this, where we have a strong level of resistance, a strong level of support, where price bounces off periodically, right? Touch right here, touch right here, touch right here, and a touch right here. This is a strong range. But in some situations, if price looks like this and it's not quite a range or an uptrend or a downtrend, just stay away from it. This is the last type of market, which is what I call choppy. It's a choppy market. No one knows what's going on. Just stay away from it, okay? Because the more you try to force entries, force setups of support and resistance, try to find structure when there's no structure given, it's going to confuse the hell out of you, okay? So big takeaways from this video, we have our pips, which is point of percentage. We have our lot sizes, our micro, mini, standard. We have our different types of support and resistance, historical levels, psychological levels, technical levels, and then we have our 4 different types of markets: uptrend, downtrend, range, and choppy. And that's about it. For homework, I want you guys to practice with the lot sizes. I want you guys to practice with the support and resistance. And lastly, I want you guys to practice identifying what type of market you're in on the given currency you're looking at. We're going to talk about market movers, specifically what moves the market, just so you guys have a clear understanding on how the market works, whether if it's from investors, whether if it's from news, announcements, so that when we move on, you guys will know what actually affects price and how price is moving each day. So here I have some notes that we're going to go over throughout the whole video. We're not going to do too much on TradingView. This video is going to be educational. Most of it's going to be educational simply because there's a lot of information I want to make sure I get through. So let's talk about it. There are the bulls and there are the bears, the bullish market and the bearish market. Now, within those two territories, we have the retail traders and the institutional traders. So retail day trading refers to the practice of individual investors buying and selling financial instruments such as stocks, options, or futures. Unlike institutional day traders, retail traders operate within their own capital rather than on behalf of a large institution. Banks, corporations, businesses that hold a large portion of capital to divide to their clients. Retail traders, it's much more public and the capital is per individual rather than company, business, or bank. So, what are some of the characteristics of retail day trading? Well, one, you have your individual accounts. Retail day traders use their own personal brokerage accounts to execute their trades. The second characteristic is smaller capital. So, retail traders typically trade with smaller amounts of capital compared to institutions because they don't really have a foundation of capital to divide through their accounts. It's off of what they make day to day, whether if it's from a 9 to 5, if it's from a savings account. It's not a business. You're trading with the capital you make day to day. The third characteristic is self directed. Retail traders make their own trading decisions, often based on personal research and analysis. With institutional trading, they usually have a organization that has a analyst group that goes day to day going over technical and fundamental analysis to spread information to their clients. Rather, with retail traders, it's up to us to do our personal research and find these algorithms that these big fish are finding. And we're going to talk more about that later in the video. But with retail trading, it's more self-directed. The fourth characteristic is use of online platforms. Retail traders utilize trading platforms and tools provided by retail brokers. So oftentimes with the brokers that are provided to the public, they have these built-in tools or built-in mechanisms for that retail trader to make their experience more convenient. And the last characteristic is high leverage. Retail traders often use margin accounts to increase their trading capital, which amplifies both potential gains and losses. So usually with retail traders, depending on the broker, you can set your margin a bit higher to have a bigger profit or, of course, at risk, a bigger loss. So what are some of the foundational strategies of retail traders? Number one, we have scalping. Of course, in the day trading industry, we call these scalpers. Now, I'm not quite sure if institutions really allow this because I know they focus more on swings to hold positions for much higher profits. When you're able to scalp on a smaller time frame, the less time it is for you to set up a bias with more confluences. And that's just my opinion. Some might argue that the scalper or the trader that makes these tiny price movements to make a large profit is just as legit as the average day trader. But from my experience, there was a lot of controversy when we had HFX, which was high frequency trading on these smaller time frames. And a lot of people were called out with their BS because they were making claims of making 1K in one day from a 1 minute trade. So it really comes down to perspective. You can see it how you want to. That's just my opinion. The second strategy is momentum trading. One of the most common phrases you'll hear is buy low, sell high, because when price is at a high premium, most people will see that as a opportunity to sell. And when price is at a discount, most people will see that as an opportunity to buy. There is this whole thing about Donald Trump with his technical stock. I'm pretty sure the DJT. I think, oh, I'm on it right now. Yeah, DJT, basically Trump Media and Technology Group. There is this whole theory saying that price is going to jump, which is why I'm looking at the chart right now so I don't miss out on this move because there was a assassination attempt yesterday. And I'm not going to talk too much about it because I don't want to get too political. But whenever there's a huge event like that, whatever stock that event is related to is usually affected. And of course, price is at a nice discount. So I'm anticipating price to push up. So the fourth characteristic is news trading. Literally just talked about it. Trading based on news releases, earnings reports, or other market moving events can affect the market. And last but not least, we have swing trading, which is the opposite of scalping. Holding positions for a few days to a week to capture short-term price swings, which is oftentimes a better solution to have a much higher profit because you're holding that trade for a longer period of time, which means price is fluctuating for longer periods of days. Longer days, more pips, more pips, more profits. So, what are some of the benefits and risk towards the average retail trader? Well, number one, you have the potential of higher returns from frequent trades and short term market movements. Number two, it's the flexibility to trade wherever you want, as long as you have access to the internet. Rather, with institutional trading, it's more stationary. So, if you think about some movies you've seen where people are in suits, they have to actually walk to a building and trade in front of thousands of monitors. Rather, with retail trading, I mean, look where I'm at. I'm in the comfort of my own space. And if I wanted to, I could take my phone, connect it to my trading view, my broker, and trade in the library. I could trade at the gym. I could trade when I'm hanging out with my girlfriend. Like, it's not stationary. Number three, which is what I think is most important, you have the opportunity to be self employed and have control over your own trading decisions. So, like I mentioned before, with these institutions, you got to dress up, sit in front of a monitor. Most of their trading decisions are from other people. They're not making their own trading decisions. It's from these analyst groups or these groups that do the research for them so that when they come into the office, all they're doing is pressing a button. As a day trader, you're going to want to make your own decisions so that you can get used to the algorithm and just uh have your own sense of reality when it comes to trading on your own time. So what are some of the risks? Number one, you have a high financial risk due to volatile nature of day trading and the use of leverage. So one of the biggest concerns about day trading to a retail trader is the amount of leverage you'll have. I know with certain brokers, they provide a 1 to 5, a 1 to 400, even a 1 to 1. It really all depends on what broker you sign up with. But the reason why that's a concern is because most people aren't informed about the leverage, so that when they use a higher one and hop into a trade and lose a lot of money, they're not as educated than the average institutional trader who knows how to manage their account more properly. The second risk is the psychological stress from rapid decision making and market fluctuations. The third risk is the potential for significant losses if trades do not go as planned. Just like how I mentioned, emotions can play a huge role. And oftentimes, when retail traders lose, when we lose the market, what happens is we do something which is called revenge trading. Because we lose one way, we want to hop back in and trade the other way. Oh, I lost because it went down. Okay, let me put in a sell. Oh, wait, now it's going up. Okay, scratch that. Let me put in a buy. And when you do that, you're basically compounding all of these losses to the point where it's hard to even reach that break even point because you're revenge trading, your emotions are taking control. So that potential loss or significant loss can play a huge role to basically burn your account. Rather, with institutional traders, they're more professional. They lose a trade, they're done for the day. They're done for that trading period. And we're going to talk more about that later in the course, how to manage your emotions. I might put it in the other series, but that is a huge risk because it adds up. And once it adds up to the point where you can't even reach a break even point, it's going to be really hard to make one single win for that trading period. And the last risk is the cost associated with trading, such as commissions and fees. So, one thing that isn't talked about as much, at least what I notice in the YouTube space, is commissions and fees. With regulated brokers, whatever trade you execute, you're going to have a small commission, maybe 25 cents, maybe $1, $2. It really depends on how big that trade is. And the reason why that's a risk is because a lot of people aren't aware. So, in conclusion, retail day trading can be an attractive activity for individuals looking to profit from short term market movements. However, it requires careful planning, strong risk management, and continuous learning to navigate the inherent risk and volatility of the markets. So, what are some of the characteristics of institutional day trading? The first characteristic is high volume. Institutional day traders often execute large volume trades, which can influence market prices. So, one common myth that is popped up is that the institutional traders move the market much more than the retail traders. And that's not so much of a myth because it is actually true. According to data from Morgan Stanley, individual investors, retail traders, account for around 10% of trading volume in the stock market on any given day. So, this is why we as retail traders are trying to find the same moves as these investors, these institutions, because if we trade against the higher, I guess, the higher perspective of the market, we will ultimately lose money because these institutions make up 90% of the stock market. So why trade against them when we have the privilege to trade with them? The second characteristic we have is advanced technology. So institutional traders use sophisticated trading platforms and algorithms to execute their trades more quickly and efficiently. The third characteristic is professional teams. Just like I mentioned, institutional day trading is usually conducted by teams of professional traders who specialize in specific markets or strategies. If I had to guess, there are several groups within a corporation or organization that has a set role for the day or month, whether if it's a analyst group, a news group, a technical group, the list goes on. Only one can really imagine how professional they have these areas built for a company. The fourth characteristic is access to information. Institutions have access to extensive market research, real time data, and analytics, providing a competitive edge to the retail traders. And last but not least, we have risk management. So, of course, these institutions implement a risk management protocol to mitigate potential losses from day to day trading activities. So, with the retail traders, we don't really have a protocol. We are trading with however amount of capital we want to, with whatever risk management plan we want. With these institutions, they have these built in protocols so that the whole organization, company, institution doesn't lose a big margin of their capital for that day. So, what are some of the benefits and risk? Well, number one, institutions they have potential for high returns due to the large capital and advanced tools. Like I mentioned before, these institutions have extensive market research. They have more advanced trading platforms and algorithms to help them trade on a daily basis. Another benefit that these institutions have is the ability to influence market movements due to large trade volumes. Like I mentioned previously, institutional traders make up 90% of market movements. So, in conclusion, institutional day trading plays a significant role in the financial markets, providing liquidity and helping to maintain market efficiency. However, it requires substantial resources, expertise, and risk management to be successful. Just like retail traders, all of these components play a huge role on how successful that individual trader will be. But with institutions, they have more of a competitive edge because they have these built in resources already provided. All right, so the next category we're going to talk about is smart money concepts. For those that are new to my page, you might be wondering, why is his name Smart Money Ace? Well, smart money is a term I took from smart money concepts, which are basically concepts and algorithms that these institutions are usually looking at. So, smart money concepts in day trading refer to strategies and indicators that traders use to identify the actions of institutional investors, often considered the smart money due to their resources, experience, and access to information. By tracking smart money, retail traders aim to align their trades with those of institutional players, believing this will lead to more profitable outcomes. All of that information is what I consider market movers because they make up most of what happens in the market. But the next category that I want to go over real quick is the common myths of day trading. Let's just run through this because I know this is a pretty boring video. I do apologize. But the good thing is you guys get to look at my face. So I wrote down 10 myths, which I think are the most common or the myths that I hear the most about day trading for those that aren't in the industry. And the first one is that day trading is easy money. The reality is that day trading requires significant skill, experience, and discipline. It involves substantial risk, and many people lose money at the beginning. I know when I first started, I lost around 1K in the first 4 months, and I was shook. I was heartbroken. I was thinking that I was gonna be a millionaire within a year because I was obsessed with watching like the lifestyle traders and the people that were flaunting
all the money you can make. And I was pretty much hypnotized at the very beginning, thinking that it was going to be easy. But yeah, I had to learn my lesson, you know. And not to say that it's really difficult or to scare you guys that are looking to start trading. It's just that there's a whole misconception that day trading is like a walk in the park. You got to commit. You got to fully commit if you want to take this serious. Okay. Number two, I kind of mentioned it before, is the fact that people say you can get rich quick from these gurus, these online gurus that kind of flaunt the lifestyle, the Lamborghinis, the food, the chains, the bust down. Like, this is one of the reasons why I'll say Forex is kind of pushed under the rug, because we have all of these traders that kind of misrepresent what trading is all about. It's not about getting rich quick. It's about having a way of it's about having a way of capital circulation to invest towards the thing that you really want to do. But when you kind of see trading as a get rich scheme, it ruins the point of what trading is supposed to be. So in reality, while there are some stories of traders making large sums of money in a short time, there are exceptions rather than the rule. Most successful traders build their wealth gradually over time through consistent gains and careful risk management. And this is how you should be doing it, taking small steps each day to have a small percentage rather than having a huge percentage and then potentially having a huge percentage loss because you're so greedy. But in reality, there are people that are doing this every day as a career that don't even have social media. They take it serious. They say, "Hey, if I can make these small wins on a day-to-day basis, eventually I can up my lot sizes like we talked about on day 1 or day 2, where eventually that 10 pip win would make me $100. That 10 pip win would make me $1,000, 10K, and it goes all the way up until you can scale to whatever amount you want to make. But when you hop into this industry thinking you can get rich quick, oh, I'm gonna flip $3 into 1K overnight, you're going to lose money. The third myth, or I'm sorry, we just talked about the third one. No, that was the second one. Okay, the third one. You need a lot of money to start trading. I know many people that are trying to get into trading believe that you need 1K in your account to be successful, or 10K, and that is a huge myth. I know when I first started, I had a minimum deposit of $100. I don't think I don't believe you need like 1K to get started. It really depends on what broker you use. I know some brokers even allow you to deposit a minimum of $50, which is great. And the good thing about retail traders is that these retail brokers, they allow you to trade with that minimum. Rather with institutions, to get into an institution, you got to have a set balance. The fourth myth is you can trade successfully based on tips and predictions. So relying on tips, rumors, or predictions from others is not a sustainable strategy, in my opinion. Oftentimes, a lot of people are looking at, live streams. They're in these groups like IML Academy, and they're trying to take these predictions off of other people, which is kind of contradicting because you guys are watching me and listening to all my advice. But I guess what I'm trying to say is, when you get into the habit of listening to other people, you're not going to form your own bias on a day to day rhythm, so that if you're not on social media, if you're not on YouTube watching someone's live stream, you won't know how to make money on your own time. Number five, we have more trades mean more profits. This is a huge myth. Overtrading can lead to increased transition cost and greater exposure to market risk. Quality trades based on sound analysis are more important than quantity. Remember that. That's very important, because oftentimes beginners like to over leverage because they have such a small amount in their balance that they're starting with, that they think if they put in a whole bunch of small trades, it will build up to a much higher profit. But what you're doing is over leveraging, which means your account is at a much higher risk than taking a smaller trade with a better quality setup. Number six, trading is just gambling. I hate this myth so much. Whenever I hear people say that trading is gambling, it pisses me off. Gambling is more of like a casino based guess, where you're walking in a avenue or an event, or you're doing something where you don't have any confluences. You don't have a bias off of research, fundamental analysis, news, technical analysis. Then with gambling, you're taking a guess. Am I going to win? Am I going to lose? With trading, although you're taking a guess, those predictions are heavily influenced by real world events, whether if it's news or if it's a market technical analysis. So in general, while both involve risk, day trading relies on analysis, strategy, and risk management. Successful traders use data, trends, and various indicators to make informed decisions, unlike gambling, which is based on chance. At number 7, we have day traders must have a background in finance. Fun fact, as a college student, I actually majored in finance, but did I need that in order to be a successful day trader? Absolutely not. While a background in finance can be helpful, it is not necessary. What matters more is the willingness to learn, discipline, and dedication. At number 8, we have day trading is only for the young. If you're watching this, if you're in your 30s, 40s, or even 50s, 60s, or even 80s, I don't know. I know a lot of people online are young, which can be very discouraging to people that are much older, but it's not too late. It's never too late to start trading. At number 9, we have technology and algorithms guarantee success. Although technology and algorithms can enhance trading efficiency, they do not guarantee trading success. Human judgment, experience, and adaptability are crucial elements in successful trading. And last but not least, day trading is all about technical analysis. While technical analysis is a significant aspect of day trading, many successful traders also incorporate fundamental analysis, market sentiment, and news events into their strategies. So, in conclusion, day trading is a complex and challenging activity that requires more than just luck or intuition. It demands a combination of knowledge, experience, discipline, and risk management. Dispelling these myths can help aspiring day traders like yourself approach the market with realistic expectations and a better chance of success. And that is all I have for this video. So we have 4 books that we're going to go over. The first one being Atomic Habits by James Clear. Now, I used to have a hard copy of this book, but I gave it to my ex-girlfriend, which was a huge mistake because now I want it back so I can read it for the 4th time. This book has probably been the most impactful just because it really underlines the importance of having really good habits. So James Clear, who is the author of this book, focuses on the power of small changes in behavior to achieve a significant improvement in one's life. And here are some of the key concepts that I highlighted. You guys can read over this if you want. But we have the power of tiny habits, the 4 laws of behavior change, identity and habits, habit stacking, the role of environment, which is really important, as I talked about in a previous video, having a good environment to set your goals throughout the day, and then the plateau of latent potential. You can purchase this book online at Amazon for 14 bucks for the hardcover. So if you guys have the time, I highly recommend you check this out. It is worth to read. Um, Me personally, it changed my life, how I think on a day-to-day basis, how I pretty much set standards for myself in terms of becoming a better version of myself, adapting to healthier habits so that I have a healthy mentality. This book does that for you. Tiny changes, remarkable results. Okay. The next one is What Color is Your Parachute? So, What Color is Your Parachute is a practical manual for job hunters and career changers. Most people try to avoid working a 9 to 5, but I'm going to be really honest with you guys. Working a 9 to 5 is something you're going to have to do when you first start so that you have some sort of capital circulation. So, one thing that helped me when I was trying to look for a side hustle or side gig while I was learning day trading was this book because it gave a lot of key pointers, a lot of good advice, and a lot of good examples of convenient jobs for someone like me. So this book written by Richard N. Boyles is a influential career guidebook. So here are some of the key themes and concepts. Again, you guys can pause the video and read this if you want, but we're just going to highlight the main point. So you have the self-assessment, you have the flower exercise, which is really important. You have the proactive job searching section, creative job search strategies, and the importance of networking. And this book can also be found on Amazon for $13, which isn't too bad. And I actually have this hard copy with me right here. So it's not too long. It's about 300 pages. Not too bad. So yeah. The next one we have is Naked Forex, which is a book I also have with me. A very helpful book that I think everyone should be reading in this video. So this book pretty much highlights the importance of high probability techniques for trading without indicators. And I talked about this earlier. I want to help adapt you guys into traders that don't use indicators, just using naked price, because I want you to get in the rhythm of having muscle memory so that you can hop into the charts, understand what's going on, and then execute without having to draw in so many indicators, wasting time on the charts, and potentially missing out on a move because you're so focused on indicators. So this book right here, written by Alex Necritin, I think I'm pronouncing his name right, is extremely helpful. I read this like 10 times, not gonna lie. So some of the key themes and concepts that I highlighted, you have price action trading, understanding market behavior, trading without indicators, high probability trading setups, which is extremely helpful. They give so much game in this book. In my opinion, it should be a lot more expensive. You have risk management, and then you have real life examples and case studies, which is also extremely helpful because it's one thing to explain information, and then it's another to actually show examples of real market data. And this book can be purchased on Amazon for $41. It is pretty expensive, but I have a free version online in my Discord, which is completely free. So I'll leave a link to my Discord in the description in case you guys want to quickly hop in, download the PDF, and leave the community by all means. But that's that. All right. Next we have trading in the zone, which I also have with me. So trading in the zone, this is more focused on the psychology aspect of trading, being able to manage your emotions, how to have discipline, and the reality of day trading if you're going to take this serious. And this book is by Mark Douglas, who is the author of The Disciplined Trader. So some of the key themes and concepts, you'll learn the importance of psychology in trading, the beliefs and perceptions, the probabilities and uncertainty, and how to manage your emotions. If I had to rank it on the list of importance, I would say it's right above what color is your parachute, only because yes, this is important in terms of psychology, but I really want you guys to get naked forex in terms of techniques and systems, strategies, methods, because I think this comes first and then this comes second. And that's just my opinion. I mean, that's the order I read these books, and you can find it on Amazon for $35. Yeah, it's pretty expensive, which is why I don't think it's worth it. Just because you can find a whole bunch of videos online talking about psychology. Rather with this, it has market examples that can't be replicated. Now, I understand a lot of people aren't going to read these books simply because you guys don't like reading, but I promise you it's going to be helpful. I will like I said, I'll leave all the links down below so you guys can find these PDFs or where to buy these books. And for homework, I mean, again, I'm not going to force you to purchase anything, but I do advise you at least read Naked Forex and Atomic Habits. The other two books aren't really as important in my opinion, but it also is helpful. So do as you wish. You know, I can only give you so much advice. I can't force you to actually make the purchase. So in today's video, we're going to be talking about top-down analysis. Top-down analysis is a concept that most advanced traders use on a day-to-day basis to find an overall trend or perspective to enter in on lower time frames. So in simple terms, top-down analysis in day trading involves starting with a broad view of the market and then narrowing down to more specific details to identify trading opportunities. So here's how it typically works. I'm going to divide this into 5 sections. We have global economic analysis, we have national economic analysis, market sentiment analysis, currency pair analysis, and then we have our technical analysis. All of these attributes play a huge role on how one should use top-down analysis. Is it really important? Not necessarily, because when it comes to trading, we want to simplify all these concepts to put it into one. But if you were able to identify all of these pointers while you're doing top-down analysis, you should be good to go. So let's start with the first one. We have global economic analysis. So with global economic indicators, traders access worldwide economic indicators such as GDP growth, inflation rates, employment data, and trade balances. These indicators provide insights into the overall health of the global economy. Number 2, we have national economic analysis, understanding the monetary policies of major central banks. For example, the Federal Reserve or the European Central Bank, including the interest rates, can forward guidance. We also have economic data releases, so keeping track of key economic data releases. For example, we have the non-farm payroll, which is NFP. It is the first Friday of every month. We have CPI, which is the consumer price index. We have PMI, the list goes on. And I'm gonna cover more depth news in another section, but I want to focus on top-down analysis for this video. At number 3, we have market sentiment analysis. So identifying the current market sentiment, whether if investors are in a risk on, preferring high risk entries over a risk off, or over risk off entries, which is more of a safer mode. So the fourth one is currency pair analysis. So starting with major currency pairs, for example, Euro USD, if we're talking about Forex, you're going to want to get in the habit of identifying the overall trend for these currencies, because the main objective of top-down analysis is to find and capitalize on the best trading opportunities. And last but not least, we have technical analysis. So we have chart patterns, right? Identifying head and shoulders, double tops, double bottoms, market gaps, general price movements, right? And with that, most people use technical indicators. But with indicators, I'm not too crazy about them. And in this course, I'm not going to go over indicators, because I want to emphasize naked charts to get into the habit of naked trading, so that you have a more simple and approachable perspective for the market. And then obviously you have your support and resistance, being able to identify structural points in the market, whether price is below or above a given zone or area. When using top-down analysis, this usually helps when trying to understand potential price barriers. By following a top-down approach, many day traders can align their trades with broader economic trends and market conditions, potentially increasing the likelihood of successful trades. Let's go ahead and look at a few examples. So how this is going to work, what I'm going to do is go on, how much time do we have? This is going to be a quick video. Let's go over like 6 pairs. We'll cover different categories. So we'll start with Forex, we'll do commodities, and then we'll do futures. And if we have time, I'll talk about crypto. So first things first, we're going to grab our replay tool. And what I think I'm going to do is just close my eyes and scroll and pick a random spot in the market. So I'm just going to close my eyes real quick and scroll and scroll and scroll and click right here. Okay, so we landed at this particular area. And the first thing that I'm going to do is scale out on my daily time frame, which I'm already on. Now, when you use top-down analysis, ideally, you're going to want to start on the daily time frame. If you're a trader like me, trading certain sessions, New York, London, Asian, Sydney, and you're trading for maybe what, 1 to 2 hours, you want to trade for that day or that trading period. So the first thing you're going to want to do is identify what type of trend you're in. I think in a previous video, we covered the 4 type of trends, whether if you're in an uptrend, a downtrend, a range, or choppy market. So if I go ahead and scale out on the daily time frame, first thing that I'm noticing is that price is starting to push up. Right? We had some structure right here, but as you can see, price broke that previous high right here, and now it's doing its own thing. So one can say that it's about to form a nice bullish trend, because we had this nice break, and now we're simply waiting for the retracement. So what I'm going to do after identifying the overall market is scale out some more to see if we have any history. So one thing that I've noticed is that we have previous structure right here where price was in a range for some time. It had a nice dip, a fake out, came back in to this range, and then finally broke structure. And then its retracement respected that newly formed resistance, right? Because we had a break, and this would be the retracement for a continuation. So because we had that break and the market is still trailing under this range and then eventually pushes back in, we could be at a nice level to have another sell. So since we're in a bullish market, one confluence we can add to support a sell bias is that, hey, since the market has to eventually retrace before it has a continuation, we could optimize on a sell before we get that next bullish push. And then the second confluence being that we're at this nice market gap and price finally came back to that previous resistance or daily resistance. So what I'm going to do is scale in on the 4 hour. And this is when you're looking for more structure, or if you want entries. I usually wait until I get to my 2 hour or 1 hour, but we could also just enter in on the 4 hour. But what I'm going to do is go in the 2 hour and try to look for a nice pivotal point to enter in for a trade. So what I would do, since price is opening above that level, I would actually place a nice sell entry below like this, place my stops to the previous high, which would be over here. Sorry about that. And we want to make it a little bit chunky just in case we have a wick. Let's make it 10 pips above that previous high. And then we want to set our TPs to the nearest zone of demand. So we want to scale this bad boy all the way down here, making this a solid 1 to 3 risk to reward. In this trade, we would be risking 60 pips for a reward of 180. Okay, so let's go ahead and press play and see what happens. All right, price is in. Oh, we got stomped out just like that. Let's just see what happens. I want to see if it respects our daily perspective, and boom, price is in profit. I mean, if we weren't stopped out previously, push it down, push it down. And TP smacked. Beautiful. So I'm kind of glad that this was a fail in a way. Although it did respect our daily perspective, we still got stomped. And I'm kind of relieved in a way because I don't want this to be like a perfect course where I'm winning all the trades, because that would be really sketchy, honestly. This is the show that you will lose, although you have a nice strategy, a nice method, and it's supposed to be in your favor. You're not always going to win because there are small components in day trading, such as your stop loss placement, which would cost you or could cost you the outcome of your trade. So let's just review this real quick. As you can see, I did get wicked out, so it wasn't like it had a nice point of retracement. Sometimes you'll see this where price will wick out, grab orders before pushing to the side or favorite side of that trading period. So the first thing we did was identify the overall perspective. We said, hey, price is pushing up, but we're still waiting for that retracement. And notice how we stopped right at where price is at that determined retracement, where price is pushing up for an uptrend, but then it's making its way back down for that retracement. So we wanted to capitalize on that sell opportunity. And then we added that confluence to our previous level of resistance that we had over here, saying that, hey, price is also at this nice given area that I respected a long time ago. So chances are it's going to respect it again. So we entered in for a nice sell. We had our stops above that given support. And I think what I should have done was placed it a little higher where we had that previous support at around 1.13073. Looking at the history of price, we could have had a nice stop over here. This would have been more ideal, and we would have been pretty safe in that trade. And then price pushes down, and we have this nice market fill back down to 1.09883. Alrighty, on to the next pair. We have USD JPY. Again, I'm gonna close my eyes. I'm gonna scroll. I'm not cheating. I'm not cheating. Let me just click on a random point in the market right here. All right, so first thing first, we're gonna go ahead and scale it on the daily time frame, which I'm already on. So one thing that I'm noticing off bat is that this pair was trailing down for some time, right? We have a lot of momentum for a nice bearish push. We have lower lows, we have lower highs, right? Right here, just so you guys can visually see what I'm talking about. We have some lower lows and we have some lower highs. But eventually, structure is broken. Why? Because after this lower high, we have a nice break of structure at this area. You guys see that? Where price eventually pushes up and breaks this trend. So whenever you have a break of structure, that trend is no longer active. So because we have this break, we are now looking for a trend reversal. And at this area, we can see that price is starting to form that structure. Why? Because after the break, we have a retracement, and now price is continuing up for a nice continuation. So now that we've identified our overall perspective in the market off of the daily time frame, we can now scale in. So now that I'm looking for buys, I'm going to go into the 1 hour or smaller time frames with that mindset. Okay, price is going down, price might be pushing down right now, but overall, I'm going to look for buying opportunities. And as you guys can see, we have this nice level of support that we marked up from our higher time frame that is still relevant to our lower one. So on the 1 hour, I'm noticing that price had this nice break into our second range right here. And then it does its thing for some time. It has a nice touch right here or a wick off of that support. And then it has a nice wick off of it right here. So we have a nice level of support. We have nice structure forming that might be a confluence for our overall bias. So if price makes another touch, we can anticipate price to continue back up. Why? Because we're going off of our daily perspective. Yes, price could sell, but when it comes to day trading, you want to look for the most probable or the highest probable setup. So when it comes to the highest probability, your higher time frames are going to be much more respected than your lower ones. So instead of going from the lowest time frames to the highest ones, you're going from the highest ones to the lowest ones, which is why it's called top-down analysis. Okay. So in this particular situation, I'd probably put my entry at around this area. I put my stop below the zone of previous demand, and we'll talk about supply and demand uh, in another video. Maybe I should have talked about it before this lesson, but I'll probably talk about it in week 2, and then I would target this high for a nice one. Yeah, let's not be greedy. Usually I just go for a 1 to 3, and I take partials when I'm at TP2, but for this example, let's just go right at this high right here, and let's see what happens. All right. Moment of truth. 3, 2, 1, play. TP3 smack for 160 pips. Beautiful. Just like the previous example on, I believe, Euro, what were we on? Euro USD. That could have gone really wrong if we didn't have a nice stop loss placement. So oftentimes, like I said, you won't win 24/7, although you have a nice strong bias on the daily, monthly, or weekly time frame. Whatever time frame you're using for that highest perspective, scaling down, although it could be really accurate, your trade is more dependent on how you set up your trade and execute, where your stop loss is at, where your take profit is at, how much risk you're using in a trade. All these components determine whether a trade will be successful or not. On to the next example. We have GBP USD. What I'm actually going to do, because we have we have three forex pairs, two commodities. Okay, I'll do two. I'll do two for each category. So we're gonna skip GU and go to gold. Gold, which is a commodity, moves similar to forex pairs, but it also has its own fast pace as if it's a indice. So this is why I love gold, because it has a mixed fluctuation of volatility. It's not too slow and it's not too fast. But yeah, let's go ahead and close our eyes and pick a random pair. Let's make sure I have the replay button active, and let's just find a random spot in the market. So I'm closing my eyes. I'm closing my eyes. Let's just find a random point in the market, and let's click right here. Alrighty, so here is the designated area that we're going to be working with, that the gods have favored me with. So first things first, what we're going to do is go on our daily time frame, which I'm already on, and see what's going on. So the first thing that I'm noticing is that price is pushing down. And when we have nice consecutive candles like this, bearish candles back to back, one might say that, oh, since we have these consecutive candles, let's just look for sells. You don't want to do that. The first thing you want to do is identify what type of market you're in. Because although we have these nice consecutive candles back to back, we don't have any structure to confirm that we're in a bearish market. If price did retrace a little bit and then pushed off of this level or this newly formed resistance right here, then we would have some sort of structure of lower lows and lower highs, this being a much lower high than this high, and this being a lower low than this low. But we don't have any of that, right? Looking at this area, it's pretty choppy. What I'm going to do instead is figure out if the market is heading towards a historical level of support and resistance, like I talked in the previous video. So as you guys can see, we have this nice strong level right here. Since the market did react from previous price, we had this nice push over here into our second range, and then price reacted over here again, confirming that we have a nice strong level. And we also have this nice push where the market forms some sort of gap. And from my experience, I think I'm going to talk about it in another video when we talk about order blocks and supply and demand. But when the market forms a gap like this, oftentimes that gap is respected. So if anything, I'm going to go with the perspective that the market is pushing down, but heading towards this nice level for a nice reversal. So scaling into the 1 hour, let's go all the way to, let's just go in the 2 hour. I think I did the 1 hour for the last example. We can see that the gap is much wider. So what I'm going to do is place a nice sell, or I'm sorry, I'm going to place a nice buy. We're actually going to execute on the 4 hour so that we can see our levels clear. And let's go ahead and place a buy and see what happens. Now, For those of you that already know how to trade, you might be confused on how I'm entering into the market since price isn't at that area. So I forgot to cover this. My apologies. But with the day trading, you have four ways of executing your trades. You can sell, you can buy, you can place a sell limit, you can place a sell stop, and I said four, that's six. My apologies. You can manually buy, manually sell. You can place a sell limit, a sell stop, a buy stop, and a buy limit. So in this situation, I would be placing a buy limit. And that's one of the things I really like about day trading because let's say if you're waiting for price to hit a certain level where price is still fluctuating and it will take like 2 hours, 4 hours for it to reach that point, you can set your limits, you can set your stops, and then go about your day until your alerts are triggered. We can make this a nice 100. We'll make it. I don't want to be too risky. We'll make it 100 pips or 110, just like that. And then I'd place my TP right. I'd make it a nice 1 to 3. Let's not be too greedy. And let's see what happens. 3, 2, 1. Let's go. And TPs are smacked. Price was a bit stagnant. It was going in and out for some time. It was going up, it was going down, it was going up, it was going down. But one thing we can say is that price respected our level of support or our historical level of our daily time frame, which was around this area. We didn't have a closure below that level on the 4 hour or even daily time frame. On the daily, it's even better. We had this nice wick confirming that it respected this level. And what happened? Price shot all the way up and TPs were smacked. So in this trade, I would have made over 300 pips. A micro lot size of 0.01 would have made us a profit of $32. A mini lot size of 0.01 would have made us 320, and a standard lot size of 1.0 would have made us 3K. Alrighty, on to our next example. We have oil, which is another commodity. You guys know the drill. Let me go ahead and close my eyes and find a random point in the market. Okay, so first things first, let's go ahead and go on the daily time frame. Let's scale out, see what we can see. So first thing that I'm noticing is that price is in a bullish channel. We can obviously see that price is forming some sort of structure. We have some higher highs and higher lows right here and right here. Let me go ahead and place these markers so you guys know exactly what I'm talking about. We have some higher lows and we have some higher highs. Okay, so since we're in a bullish market, ideally, we would be looking for some buying opportunities. But with every uptrend and downtrend, you also have to take in consideration that eventually price is going to have a retracement. So one thing that I like to do whenever I'm in a channel is place a fib from the bottom of that push to the top to see where we would have that nice retracement. And if it's near that level of that newly formed support, I would anticipate price to make that move. So in order to find a nice pivotal point for that retracement, let's try to identify any historical levels of support or resistance. So if I go ahead and scroll to the left and see where price is aligned with, I notice that we have a nice level of resistance right here, or our daily resistance at around 93.141. And since price isn't yet at that level, I'm going to anticipate price to eventually reject our daily resistance to make that present retracement for a bullish continuation. So let me go ahead and highlight this area and let's go ahead and scale into the 2 hour time frame. So price is pushing up, What I'm going to do is go on the 4 hour. Let's see if price is still reacting off that level. We have a nice touch right here. We have a nice touch right here. 2 touches signifying that this is a nice level that price may or may not react off of, but it's only a matter of time. So let's just go ahead and test this out. Let's go ahead and place a sell limit, meaning we're waiting for price to hit an area and sell off. So I'd get my sell position tool, and my stops would ideally be above that previous high right here. So let's go ahead and scale it to 93.73. And then I'd probably just make my take profit a 1 to 3 like this. Now that we have a daily perspective, we're on the 4 hour, we have our entry ready. Let's just see what happens. 3, 2, 1, let's go. and we're stomped out. Look at how perfect it hits our stop loss and then shoots back down into profit. So just like our first example, it really comes down to our stop loss placement, but our overall bias was respected. We had a nice touch on our overall resistance, and then we had a wick off of our previous high before price went into profit. If I continue to press play, let's see what happens. TBs are smacked and price pushes down. Beautiful. So again, you won't win all the time using top-down analysis. It's just good to add on with other confluences to have a better trade. So later in the course, we'll learn more about stop loss placement. So when you add another confluence with a stop loss placement with your top-down analysis entry, you'll have no problem catching setups like this. So for our next example, we're going to be talking about some futures. Futures. All right, so we're on S&P 500. This is one of the most popular futures that most people trade, and we're gonna do the same thing. So let's go ahead and close our eye. But first, let's get the replay button. Make sure we have it highlighted, and pick a random point in the market. So I'm closing my eyes. I'm scrolling. Closing my eyes. I'm closing my eyes. Let's go right here. So just like the other pairs, the first thing we're gonna want to do is identify what type of market we're in. Are we in an uptrend? Are we in a downtrend? Are we in a range, or is it choppy? Well, we're not in an uptrend because I can't find any higher highs or higher lows. And we're also not in a downtrend because I can't identify any lower lows or lower highs. So in this scenario, I would either identify some sort of range formation, or if it's choppy, I'd leave it alone. So one thing that I'm noticing is that we have this nice level of support right here, or newly formed resistance, since price is breaking structure right here. And I can't really identify some sort of previous resistance. So we're just gonna work with this level right now. So with this singular level, we're gonna try to use this to our advantage. So what are we noticing right here? Well, we have a touch right there. We have a touch right there. So this is a strong level of, did my TV just turn off? It did. Whatever, I'll ignore it. So we did just have a, oh, is it back on? Give me 1 second. God damn it. Short little break. So although price did break this strong level of support, which is now our newly formed resistance, we can still use this to our advantage. Why? Because since price is pushing down on the daily time frame and we're not yet able to identify a bearish market, well, how does one market usually form? After having a break of structure. And what is price doing right now? Breaking structure. So I'm going to anticipate price to eventually have a nice retracement and then continue down. So in this example, the daily perspective would be a anticipation for a bearish continuation or bearish trend formation. So I'm going to go ahead and scale on my 4-hour and see if we can try to find a entry point. So price is pushing down. I'm going to say if price decides to retrace back up, we're going to enter in for a nice sell. So I get my short position, place it right here, have my stops above that previous high, make this a nice 1 to 3, or we'll make it a 1 to 3, see what happens. And press play. 3, 2, 1, let's go. We're not in the trade yet, by the way. We have a nice sell limit waiting for price to hit our entry. And boom, price is activated. So we're in the trade and price pushes in the profit. We're in profit. We're in profit. And TP smacked. Beautiful. Love to see it. You love to see it. I was a bit worried, not gonna lie. But this respected our daily bias. Why? Because price had a nice retracement at around this area before pushing back down for a bearish continuation. Beautiful, beautiful, beautiful. On the daily time frame, you can clearly see that it's starting to form some structure. We have some lower lows right here and some lower highs. You love to see it. All right, and I think I'm gonna stop it right there. We had some examples on Forex pairs, we had some examples on commodities, and then we had an example for futures. And I was gonna cover more examples, but honestly, your boy is getting tired. Oh, and I just realized I had some PDFs I wanted to go over. We can go over it now. So here's an example of top-down analysis. Let me go ahead and zoom in a bit. I think that should do it, where it's basically telling you that if your daily perspective is a bullish trend, but the market might be bearish on a lower time frame, which is that green highlighted section, you're still trying to look for buying entries. So notice how they have this highlighted section and it's pushing down, but in actuality, these investors or whoever was trading during this time is waiting for price to hit that nice trend for a bullish continuation. And here's another PDF where it shows you the daily time frame might be bullish, but on a smaller time frame, zooming in, it might show a bearish candlestick, simply waking off of a smaller area of demand, right? Or support, simply waiting for a nice entry back up to the upside because your daily perspective is bullish. For homework, I want you guys to practice TDA in the active market, starting on your daily time frame, trying to figure out what type of market you're in, and then scaling in to find entries off of that overall perspective of the market. So the break and retest is a common trading strategy in day trading and other financial markets that involves identifying a significant price level, then waiting for a breakout, and then entering the trade when price retests the level. And I broke up this concept into 4 categories that I want to go over real quick. So the first one, you have identifying key levels, support and resistance. Traders identify key support and resistance levels where the price has previously reversed or consolidated. These levels are often psychological price points, previous highs or lows, or any area that has a lot of trading volume. The second category is the breakout, when price breaks through a significant level of support or resistance. And I actually have a PDF that we can look at while I'm explaining this so that you guys have a better idea of how this works. We'll look at this one first. So a breakout above resistance indicates potential bullish momentum, while a breakout below support indicates potential bearish momentum. So in this example, we have a range up here and we have a range down here. Why are these two ranges divided? Because we have price fluctuating above this level of support, and then we have price fluctuating below this newly formed area of resistance. And as you can see, we have this nice breakout into our second range off of this bearish candle. So once we have this break, price fluctuates, and then we have a retracement, which is the retest back up to that newly formed resistance. We have a touch right here and we have a touch right here. And since we have a breakout below support, this indicates potential bearish momentum for sales. Why? Because this is the break and this is the retest. And then on our second example, we have the opposite, where we have a break above support, or this area dividing our ranges, range 1, range 2, where after the break, we have a retracement or retest back down to that newly formed support or zone to catch a nice entry for buys. The third category, like I just mentioned, is the retest. After the initial breakout, the price often retraces or pulls back to the broken level. This pullback is a test of breakout strength, and most traders use this as price action confirmation. In general, traders look for specific price action signals during the retest, such as candlestick patterns that indicate the level is holding as new support, of course, after a resistance break, or new resistance after a support break. The fourth category, which is the most important, is entering the trade, or knowing when to enter the trade. Traders enter the trade when the retest confirms the level as new support or resistance. This confirmation can be a bounce off the level or a specific price action signal. And then once you enter the trade, the most important factor is knowing where to place your stop loss. So a stop loss order is typically placed just below the retested level for long positions, or just above it for short positions to manage risk. If we go back to these images, most traders would place their stop loss above this zone after we get a retest for a sell, and then most people would place their stop loss below this zone for a buy. So one thing I really like about the break and retest is that it helps filter out false breakouts, as the retest provides an additional layer of confirmation. And we're gonna go ahead and look at 5 examples for this video, explaining what an ideal breakout or break and retest setup looks like. This strategy is widely used because it combines both momentum, the breakout, and the confirmation, the retest, to help traders make more informed trading decisions. So for the first example, we have Euro JPY, and we're just gonna run through this pretty quickly. This is gonna be a short video. But yeah, let's just talk about it real quick. So on Euro JPY, whenever you notice a big momentum candle, whether if it's a consecutive series of candlesticks back to back, bullish or bearish, or if it's a long candlestick with a lot of trading volume, that's where you wanna try to find a break and retest setup. So in most scenarios, after we have a nice candle like this, we want to try to look at previous price and what it was doing before we had this nice long candlestick. Well, in this area, if we go ahead and take my replay button, before we get that push, where was our previous levels of support and resistance? Well, if we come over here to this area, I'm noticing that we have some bullish momentum going on. We have nice bullish consecutive candles back to back. So what I'm going to do is draw out this zone, and this could be considered as 4-hour demand. So I would draw this zone out, right? We have a touch right here, and let's see what price does. Boom, we have this push, and now I'm simply waiting for the retracement back to this zone. So either right here at the 0, at the 50, or at the 100. And as we continue, price makes a retracement, we get that retest, and once we make it into that zone, I'm hopping in for a sell. So I'd get my short position, keep that stop loss above that zone for about 50 pips, and we can make this a nice 1 to 2 risk to reward. Let's go ahead and continue. TPs are smacked. Beautiful, beautiful, beautiful. And this was pretty recent. As you guys can see, I'm at current price. So you'll see these opportunities all the time to take advantage of. Let's look at another example. On GA, we have this area that I marked up earlier that we can go ahead and review, where price is in a nice bearish channel for some time, right? And if we look at previous price, getting the replay button before we get that push, where was our previous levels of support? Well, we have one right here because we have multiple touches to the upside, right here, right here, and right here. So these are 3 touches, meaning that this level is quite strong. So since we have a strong level, we have our ranges divided, range 1 and range 2. So price is fluctuating in range 1, and we're keeping an eye out in case we get a nice breakout into our second range. So as I continue, we finally get that break. And since we have a candle closing below that level of our newly formed resistance, we know that there's a higher chance that it's not a false breakout. So what I'm going to do is mark this level right here and simply wait for price to retrace. So as I continue, look what just happened. So we had our previous level of support lined up. We had a nice break, and now we're waiting for price to retrace. But it's not retracing to that level. Well, why? One of the biggest mistakes that I see traders make, they have a determined level they want price to fluctuate to, but sometimes it might be respecting another level. So if we come over here, notice how we also have this previous low that price respected. So this could also be a level that price is eyeing. And then if we go over here as well from previous price, looking at these historical levels of support and resistance, we also have a nice break over here, which price respected later on for that break and retest for a bullish push. As you guys can see right here. Let me go and mark this up so you guys see exactly what I'm talking about. We have this nice break. Price fluctuates a little bit, and then it pushes up from that break and retest. Price fluctuates a little bit. We have another break and retest until eventually range 1 decides to trail back into our previous one. So instead of this level, we're actually eyeing this one right here because we have price fluctuating a little bit before it pushes off of another level. So instead of waiting there, we would actually enter in at around this level. So let me go ahead and push price back a little bit before we get those bullish candles and redirect our analysis. So we would wait for price to retrace back to this newly formed resistance and enter in for a sell once we get that retest. So I'm going to click play. Boom, we get it right there. I'm entering for a sell. I can place my stop loss above that level. We can make it a nice 20 pip stop loss, and we'll make this a nice 1 to 3. Let's see what happens. TPs smacked. Beautiful, beautiful, beautiful. So make sure you guys review this example because oftentimes most traders make the mistake of having a predetermined level that they want price to eventually make its way to instead of paying attention to the historical level that price already reacted off of with several examples of that break and retest. So here on gold, we have another marked area that I noticed. And this was pretty recent where we had a nice range over here. We'll say this is range 1 and we'll say this is range 2. So price was doing its thing for some time in range 1. We can go ahead and highlight this so you guys see exactly what I'm talking about. On the 4-hour, before eventually it has a breakout to our second range right here. And then this would be range 3. But notice how we have price breaking out into range 2 with this nice bullish push, followed by bullish consecutive candles. And then what does price do? It has a nice retracement towards that newly formed support. So ideally, after we have that breakout, what I would do is have my entry ready for buys once we get that retracement. And then I'd probably set my take profit all the way up to that resistance. And then I'd place my stop loss below that level, specifically below that low right here, making this a nice 1 to 4. And let's see what happens. We press play. And as we continue, we can see that price respects this range and hits our TP. Beautiful, beautiful, beautiful. So our last example is going to be on NASDAQ, which is a future. And quite honestly, this method or strategy applies to all financial instruments, whether you're trading crypto, whether you're trading Bitcoin, whether you're trading indices. You can use this breakout or break and retest method for any pair you trade. So if we take our replay button and place it right here, notice how price is trailing up, and we have this nice level of resistance that we have marked up because we have a touch right here and we have a touch right here. Plain and simple. Now price is fluctuating. It's doing its thing. It has a nice break. We have a nice open above that level. So now we're eyeing this level of support for that retracement or retest for a bullish entry. So once price makes that touch, right here, I'm entering for buys. So I'm going to get my long position, place my stop loss below that level, try to target a previous level of support, which would be around here. And then my TP would be at the nearest resistance. If there's not a level of previous resistance, we're just going to make this a nice 1 to 3. And let's see what price does. TPs smacked. And yeah, that's all I have for this video. Hopefully it was short, sweet, to the point. And if you don't understand it, watch it again. But this was the break and retest method that you can now use on your everyday trading setups. For homework, I want you guys to backtest and identify the break and retest on your own time so that you know when to execute for a buy and when to execute for a sell. So in today's video, we're going to be talking about the Fibonacci retracement. So the Fibonacci retracement is a popular technical analysis tool used in forex trading to identify potential levels of support and resistance. So we're gonna run through this pretty quickly. Personally, I'm not a big fan of the Fibonacci retracement because it kind of takes away the whole point of naked trading, which is trying to identify setups without all these tools, all these indicators. And the Fibonacci is one of the most popular retail concepts that most retail traders use, and then oftentimes get manipulated by the investors or the people that understand liquidity and supply and demand. Although I'm not a huge fan, it is still useful, which is why I want to give you guys this video. And yeah, let's talk about it. So first things first, I'm not gonna gatekeep. I'm gonna show you guys my settings in case you guys want to copy this. So we have the style right here, and make sure you copy all of this. This is the most important section where you see all these numbers. You have 0, 0.382, 0.764. Make sure you get all of this, okay? And then we'll explain all these levels. So take a screenshot, and if you can't see them, let me know in the comment section, and I'll just send you the PDF or something. I don't know. All right, moving down. Once you guys have the numbers, background, levels, let's see, your coordinates. This should be at default. If not, make sure you copy these numbers. And then you have your visibility. This should be a default, but if it's not, make sure you copy this as well. So the main use of this tool is to identify the retracement of price when you're in a uptrend or a downtrend market. And what I'm going to do is explain these levels individually, starting with the one. So your one means it's a invalid trade. What does this mean? Well, if you have a nice setup, let's say price is moving up and it hits that golden zone, and then you're waiting for that push back up, but instead it pushes down and stomps you out or nears that one level, that means it's a invalid setup. Or if price goes anywhere past one, then it's invalid. So to the side, I'm just going to write invalid trade so it's not confusing. We have invalid trade. Okay. Oops. All right, next we have the 0.76 level. That is where your stop loss is going to be placed. So let's say you're in a uptrend and you are able to identify some sort of retracement you want to enter in at this nice level, where your stop loss would be anywhere at that level or slightly below it. Okay. Just like that. So this is your stop loss placement. We'll just say stop loss. Okay. Moving on. Next, we have the 0.618 and 0.5 levels. This is what I like to call the golden zone, which is why the levels are yellow, aka gold. Because when you have a nice fib setup, you're simply waiting for price to enter that zone to have a nice entry. So once price makes its way down here, we would enter in for buys. So this is what I like to call, do this, entry point or entry zone. Your 0.382 level is where you have historical levels. So oftentimes a lot of traders miss these type of setups because price instead bounces off of a historical level. So instead of price making its way to the golden zone, it actually makes its way to this level because there's previous levels of maybe support or resistance. For example, maybe price was trailing along like this before it reached that area where it built up structure, just like that. So instead of price making its way down to the golden zone or entry point, it instead reacts off of this level of previous resistance or new support. Okay. So we'll say historical level, if there is history. Okay. Next we have TP1, which is pretty self-explanatory. This is where you would set your take profit level, your first one, just like that. And if you notice, after entering in, it should be pretty accurate. So this says 1.7, but it's close enough. Let's say if you enter on that golden zone at that 50% level, and then you placed it just about at 0.236, it would pretty much give you a 1-to-1 ratio. So that's pretty accurate. Your 0 is TP2. This is where you would place your second take profit. Negative 0.25 is TP3. And then negative 0.618 are your runners. So in case you want your trade to run or you just want to hold it to maximize your profit, you can just call this your runner. So how do you actually use this setup in real time? So one thing you're going to want to do is identify structure. In an uptrend, you're looking for higher highs, higher lows. In a downtrend, you're looking for lower highs and lower lows. This way, it gives you more confidence that you might be in a nice fib retracement. So what do I mean? Let's say price is trailing up for some time and we have confirmation that it's in an uptrend because we have higher highs and we have higher lows. Well, since we have structure, price might respect this and have a nice continuation. So I'd grab my fib tool and place it from the bottom of that push to the top. And now we're waiting for price to enter in that zone for a nice continuation. And before we look at some trading view examples, I have some PDFs that are more visual. So we have a nice push in the market, consecutive bullish candles where price might have a nice continuation for a bullish run. So we have our fib placed at the bottom of that push to the top. And then we wait for price to dip back down to that 0.5, 0.618 zone. So once it hits that zone, we enter in for buys, and then TP1 was smacked. In this one, we have more of a clear representation of what it would look like in real time. So you have this nice push in the market. You have your fib placed from the bottom of that push to the top, and then you're waiting for price to near that 61% level for a entry. So we have 3 examples I want to go over real quick before my camera dies. So on Euro JPY, for example, I highlighted these areas earlier. I'm not going to lie to you guys. I wanted to get by this lesson pretty fast. So these are predetermined areas that I already marked up. Just throwing that out there. So on Euro JPY, I'm noticing that price is pushing up and we are forming some sort of structure of a uptrend market. Why? Because we have some higher highs and we have some higher lows. This low being much higher than this one, and this high being much higher than this one. In theory, we could have a nice bullish continuation, right? So what I'm going to do is grab my Fibonacci tool, place it from the bottom of that push to the top, and now we're waiting for price to enter in the golden zone. So we're going to go ahead and mark this area. If you notice, we also have historical levels because previously price reacted off of this level of resistance, which is our new form of support. So 2 things could happen. Price would either react off of this level at 0.382 or price is going to react at our entry point. So you could place a buy right here, but the only thing that is concerning when you do that is your stop loss placement. Unfortunately, it would have to be wider just so that you're safe in both scenarios, because if price does dip to the 0.618 level or 61%, then it could wick and then push back up. We'll scale all the way up here, actually. I think that's better. We'll make this a nice 1-to-1, just like that. And let's see what happens. Okay, TP is hit. So this is a prime example of this trade working in both favors of waiting for that entry point or entering early. Yes, I would have had a better entry if I entered in on that golden zone right here and maybe have a much greater take profit either at this level or this one. But in both scenarios, they work just fine. It really depends on what you're looking at. Again, when it comes to trading, you're looking for the highest probability. And if I have historical levels of support or resistance, there's a higher probability that price is going to react off of that level. Okay. On to the next example, we have gold. So on gold, this is actually pretty recent. I'm noticing that price is pushing up. And this tool pretty much works on all time frames except the 5-minute and 1-minute. Or at least I don't recommend the 5-minute or lower. When I first started trading in 2019, I was using this tool a lot on the 30-minute and higher. So if we even scale down onto the 4-hour, let's go ahead and get our replay button and talk about this push right here. So notice how we're forming some structure in a uptrend market. We have higher lows and we have higher highs. You guys see that? So in this example, I would get my Fibonacci or my fib and place it from the bottom of that push to the top and wait for price to push back down. And then we have some historical levels around here, which is below our 0.382 level, which is perfect. So we would have a strong bias instrument for buys. Once we get this dip, our stop loss will be slightly below this level, making this a nice 12 pip stop loss. And we can scale all the way up until it's a 1-to-3 risk to reward. Just like that. Let's go ahead and press play and see what happens. And TP smacked. Beautiful. Notice how perfect price hits our entry and spikes all the way up. Now, let's say you missed this move. Let's say you missed this setup where price already had that push, had the retracement, and pushed up again. Well, since it's in a continuous trend, you can also find these setups at these continuous points where price has another dip. So if you think about a trend as it's pushing up, you have several opportunities to execute on a buy. So let's say you entered in and around here from the bottom to the top, and then price makes a retracement at that point 0.5 level. So on our last example, we have T-bond futures, and this is a bearish example where we have structure of lower lows and lower highs. So this low being much lower than this one, and this high being much lower than this one. Now, this isn't perfect because price makes another touch before pushing back down, but you still have some sort of structure confirming that you're in some sort of bearish market. And what does price do? It has a nice push in the market, and now we're waiting for that retracement. So we would grab our tool, place it from the top this time since we're in a bearish run to the bottom. Oops, wrong tool. And now we simply wait for price to enter in that golden zone. But just like the example on Euro JPY, we have some historical levels. So instead of targeting the 50%, 61% level, we would eye price to reject off of that 0.382 level. So we're going to grab our short position, place it at that level, have our stops slightly above that 0.76, and we can go ahead and make this a nice 1 to 2. Let's see what happens. Trade is activated. And TPs are smacked. Beautiful, beautiful, beautiful. And that's all I have for today's lesson. I do apologize if this was a short video. Like I said, I'm not a huge fan of the Fibonacci retracement just because I'm trying to emphasize and turn you guys into naked traders where you won't have to rely on all these tools, all these indicators, because day trading becomes very simple once you start to have more muscle memory off of naked price. By understanding and applying Fibonacci retracement, day traders can improve their ability to identify key levels in the market and make more informed trading decisions. Now, when it comes to consistency, you'll find setups like this all the time. It's not like a one setup per week situation. You'll see this all the time depending on what session you trade. For homework, what I want you guys to do is open up TradingView and practice finding some ideal setups of a fib retracement, either in an uptrend or downtrend market. So the trading market operates 24 hours a day due to the global nature of the market, with trading sessions spanning in different time zones. These sessions are typically divided into 4 major trading periods: Sydney, Tokyo, London, and New York. So I trade in the Eastern time zone. So in this video, we're going to be going over the Eastern time zones for each pair. If you're from a different time zone, let's say Central time zone, and it's not on this PDF at all, it's a simple Google search. Simply just look up the translation of my time zone and convert it to yours. Okay. So let's talk about it. The Sydney market opens at 4 o'clock p.m. and closes at 1 a.m. This session actually marks the beginning of the trading week. It's relatively quieter compared to others, with lower volatility and trading volumes. Currency pairs involving the AUD, Australian dollar, and NZD, which is the New Zealand dollar, are much more active. The next one is Tokyo. So the Tokyo market opens at 7 p.m. and closes at 4 a.m. Also known as the Asian session, this is also one of the first biggest trading sessions of the day. It is pretty volatile and you can catch some decent setups in the afternoon. And the currencies involving the JPY, Japanese yen, are much more active. This market also overlaps with the Sydney session, providing some additional activity. So the London session opens at 2 a.m. and closes at 11 a.m. This is the most active and volatile trading session due to high trading volumes. It has a significant overlap with the New York session, leading to increased activity and liquidity. One thing to keep in the back of your head is that this market is heavily influenced by European financial centers. And last but not least, we have the New York session. This opens at 8 a.m. and closes at 5 p.m. So this one is the second most active session with high volatility. Now, this one is my favorite to trade only because it's more convenient. I wake up in the morning, and it also provides important releases of US economic data and reports. So if you're trying to study news reports, if you're trying to study what's going on in the world, I would suggest you trade New York session. It also overlaps with the London session, leading to heightened activity. In my opinion, the best time to trade is when the London and New York sessions overlap because it has a lot of liquidity and volatility. So if we look at this PDF right here, it will show you when these sessions pretty much overlap. So anytime between 8 a.m. and 12 p.m. in the morning is the best time to trade. You'll also find really good setups in the morning. I'm not sure why, but when you are trading in the afternoon or at night, the market tends to slow down. On my channel, if you click on the live section, you'll see that I have a whole bunch of videos of me live trading during these times, whether if it's London session or New York. And this is where I find most of my setups. And if that PDF wasn't helpful and you're trying to understand when these sessions are active, what you can do is add this indicator to your chart by clicking here and look up Forex sessions, Asian, London, and New York. Once you find it, put a star next to it, go to settings. And what I want you guys to do is uncheck Aussie Open, uncheck Asian Open, and keep New York Open and Euro Open. So you should have New York Open, New York Session, New York Close, Euro Open, Euro Session, and Euro On. And if you want, you can copy the style. I have red and blue. We can uncheck this one right here. And these are my settings for visibility. It should be on default, but if not, you can copy this as well. So these colors represent the sessions. We have New York, which is a light blue, and we have London, which is a light red. And then this middle section, which is purple, is the overlap. And we're on the 1 hour time frame. We go on the 30-minute. We can see this much more clear. I personally don't use this indicator because I'm so used to trading in the morning and having a set schedule for myself. And I think that's the homework I'm going to assign you guys. Get into the rhythm of waking up during your preferred trading session. So if it's London session, get in the rhythm of waking up at 3 a.m. or even 2 a.m. in the morning. And whatever session you prefer trading, create a good schedule for yourself because sleep is very important. If you're all over the place, if you're sleeping late, waking up late, you're not gonna be able to trade in the market. Okay. So find a set schedule for yourself. Test out the London session for a week. Test out the New York session for the week. And again, you guys have my live sessions as a reference to see which type of session might work for you. In today's video, we're going to talk about something I feel is a bit underrated in the trading space. I don't see too many people talking about this on YouTube. I see a lot of tutorials, but I never really see videos explaining the importance of keeping a trading journal with you throughout your trading journey. So let's hop straight into it. Keeping a trading journal for day trading can be highly beneficial for several reasons. Number one, performance tracking. By recording each trade, including entry and exit points, trade size, and the rational logic behind the trade, you can objectively analyze your performance over time. You're also going to be able to identify patterns. So if you're on a win streak with a new strategy that you picked up a week ago, and over time you're noticing that your trading journal is positive, well, that right there is a pattern that you should stick with. So oftentimes when day traders win for a long period of time and then lose, they shift strategies thinking that their methods are not profitable. But when you have a trading journal to document your trades, you'll have data to prove that that strategy is legit or that strategy that you think is not legit actually works. At number two, we have improving discipline. So a trading journal forces you to become accountable for each trade, reducing impulsive or emotional driven decisions. Oftentimes, traders break their rules in terms of risk management, over leveraging, and they tend to get greedy. I remember when I wasn't documenting my trades, I would hop into another trade that I thought would be just as profitable as the last one. By keeping a trading journal, you'll be more disciplined because you'll have a set amount of trades you're taking for that day or trading period. And with that comes consistency. Regularly updating your journal helps enforce discipline and consistency in your trading approach. At number three, we have learning and development. So, reviewing your trades from the past helps you learn from your mistakes or success, which helps you refine your strategies. I know for me, every weekend when the markets are closed, I go back and review what trades worked for the week and what trades didn't work for the week so that I can maybe shift different approaches to the market into the next week. A journal provides a structured way to reflect on your trades, make adjustments, and improve your trading skills over time. At number four, we have emotional management. I said it before, but oftentimes traders do get emotional. We don't like to admit it, but it happens. Whenever we make a lot of money in the market, we get happy, we get excited. But with that, we also get really mad and disappointed when we lose. Documenting your emotional state during trades can help you recognize how emotions influence your decisions and learn to manage them better. So for me personally, knowing that I have a detailed record can reduce my stress and anxiety because I have a structured way to review and understand how I was feeling when I was entering a trade in the market. At number 5, we have strategy optimization. So, a journal allows you to backtest your strategies by reviewing past trades and seeing how different approaches would have performed. By analyzing your journal, you can pretty much refine your strategies, eliminating what doesn't work and optimizing what does. And last, at number 6, we have building confidence. By documenting successful trades and strategies, this reinforces your confidence to stick with proven methods. And I had this PDF in the background as I was explaining everything. And this simply shows the cycle of how to create a trading journal and what it does for the average trader. So number 1, plan new trade. What were the reasons for the trade? Are you following a trading plan? And why was the trade good? Number 2, execution. Reasons and analysts at each decision point during the trade, and did you hesitate or doubt your plan? Number 3, recording the trade, attaching any charts of an entry or an exit, parameters, your stop loss, your take profit, did you have a strategy, what was the time frame, money management risk, etc. At 4, recording your emotions. How did you feel before, during, or after the trade? Were you greedy before you entered in? Did you have a lot of fear? Did you have a lot of hope? Did you panic while the trading was active? Stuff like that. And at the end of the cycle, of course, you have your review. Did you follow your trading plan? Was it a good strategy? What can be improved? All of these pointers really help define a really good and strong trading journal. And I actually have my trading journal right here for an example when I was doing the funding challenges that I passed last year, which I don't have anymore, sadly. But this helped me track all of the data while I was doing that funding challenge. And one of the biggest benefits that I had, like I explained earlier, was being able to review my trades on the weekends when the market was closed. So I had links to every trade that would show me my analysis, which was very helpful. I had my exit as well, which was very helpful. I had the date listed, I had the pair listed, I had all this information that helped me review my trade once it either hit my take profit or stop loss. So in general, or I guess the conclusion of this video, a trading journal can be kept in various formats, including spreadsheets or even a simple notebook. The key is consistency in recording and reviewing your trades to maximize the benefits. So in today's video, I want to bring you a tutorial on how to set up a trading journal that's worked for me, and I'm sure that will work for you, depending if you're a beginner, advanced, or expert day trader. So the first thing you're going to want to do is go to Google Drive and click on New and open up Google Sheets. Now, the main difference between Excel and Google Sheets is much more accessible to most people, to most users, whereas Excel is much more advanced and exclusive. You can think of it as iPhone versus Android. Majority of the population has iPhones, while others have Androids for exclusive purposes. But the good thing is with Google Sheets, you can translate it to Excel. So once you're done setting up your spreadsheet, you can download it to a PDF and it will convert that file through Excel, which is pretty cool. So before we get started, I want to emphasize the importance of having a trading journal. If you're really serious about day trading and you want to get to the point of doing this full time, it is crucial to have a trading journal. So first things first, we're going to get 2 cells and stretch this bad boy out all the way to G and merge these together. Now, what I like to do is just title my journal. We'll just do trading journal, or I'll do SMA trading journal. And then we're going to go ahead and center this like this, put it in the middle. And I like to make this bold and 18 font. Next, we're going to go ahead and customize our spreadsheet. So what I like to do is leave a gap. So we're going to skip row 3, come to row 4, and highlight all of these cells. I like to go all the way down to 200. Right here. And we're going to stretch this out to P right here. And go to Format, Alternating Colors. And I like to go to brown because it's one of my favorite colors. And click Done. Next, what I like to do is go ahead and format these cells to make it all coordinated in the middle and centered so that we know we don't have to fix this later. So I simply go up to here, center, and I click on this, middle, okay? Let's go ahead and name these columns. So we have the date, we have the pair,
We have the time open, when we got into the trade. We have the time closed, when we exited the trade. We have duration, how long were we in the trade for. We have session, were we trading New York, London, Asian. We have long/short, did we buy or sell. We have the contract size. Oops, I cannot type. Contract size. We have the entry type, entry coordinate, stop loss coordinate, take profit coordinate, risk to reward, outcome, did we win, did we lose, and profit/loss. And then the last column is your balance. Oops. There we go. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. 16 columns. Wow. So yeah, that is a lot. Now, what I like to do is come to the columns and change them to a different color. So I usually just pick white because I think it looks good. So customize it to your preference. But I like doing this. And then we're going to make this bold as well. So next, we're going to go ahead and customize the columns that need drop-down menus, such as pair, session, entry type, etc. So what you want to do is come to the columns that need the drop-down menus, go to Insert, Drop-Down, and then type in all that information. So for the pair, this is all to your preference. I'm going to stick to the pairs that I trade with futures. So we have NQ Z 2024. We have gold. We have S&P 500. Oops. And then we have the mini pairs. So that's mini NASDAQ. Actually, let me put this like this. Okay. Mini NASDAQ, which is MNQ Z 2024. And then we have mini S&P 500. And if you want, you can come to the advanced options and make it a arrow. That's what I like to do. So it looks more fancy, I guess. And then click done. Now, in order to have this drop-down menu for all of these rows, because if we come to 6, we don't have it, you want to simply come to the row that has the drop-down menu and go to the bottom right until it shows this arrow. Click on that and highlight all of these rows until you get to the end. And now you should have all of these drop-down menus. Next, we have the session. So again, we're going to go to Insert, drop down, and type in the sessions that you trade. So for me, it's London, New York, and Asian. Advanced options, make that an arrow. Bottom right, scroll all the way down. Just like that. Next, we have long/short, insert, drop down, long, short, advanced options, arrow, done. Bottom right, drag it all the way down. Done. Next, we have entry type. Or I'm sorry, we have contract size. So this is the new one that I started implementing since I trade futures. If you're still trading Forex and you still use pips, you can simply change this to lot sizes. So we go to insert, drop down, and I go all the way up to 5. So 1, 2, 3, 4, 5. Make that to an arrow. And then drag this all the way down. Boom. Next, we have entry type. So again, this is all determined by the type of trader you are and what type of entries you use on a daily basis. If you don't have specific entry types, feel free to copy mine. I won't get mad at you. So we have the flip. We have the breakout. We have FVG, which is fair value gap. We have OB, which is order block, supply and demand of that nature. And the RSI, advanced options, arrow, done. And then drag this bad boy all the way down. Just like that. And the last drop-down menu is going to be on the outcome column. So this is simply going to have win or loss. And this is important for later when we have the automated tool to help us calculate our win percentage. So this one, we're going to go ahead and go to insert, drop down, win, and loss. Advanced options, arrow, done. Drag this bad boy all the way down. Just like this. All right, so far so good. Your trading journal is coming together. So you should have all this set up where you have your columns, you have your rows, and you have your drop-down menus. So next, we're gonna go ahead and insert our max balance and initial balance so that we have an idea of how much capital we're trading. So what I like to do is come to column M and simply highlight these two cells together, merge them, and we're gonna go ahead and type out initial balance. Let's go ahead and center it like this. And then in row 2, we're gonna do the same thing, highlight these two cells together, merge them, and type out max balance. Just like that. Center it. Boom. It should look something like this. Now on the columns to the right, which are O and P, we're gonna do the same thing where we highlight these two cells, merge them together, and then type out the amount that we're starting with. In this example, let's use 10K. Let's go ahead and center it. Put in the middle like that. And since we're using numbers of currency, we're gonna go ahead and format this, go to number, and then click on currency. And boom, it should format this number so that it reads 10K. And then the max balance, same thing, merge, and let's type out 10K. Center it, format, currency. So your initial balance is how much you started with. Your max balance is what your overall balance is at the very end, okay? So this next part is going to be a bit confusing. I'm gonna do my best to elaborate, but we're gonna talk about formulas. So with Google Sheets and Excel, they have built-in formulas to help you automate certain functions. So in certain columns, not all of them, we have certain functions that we implement to make our lives easier. So for the date, the pair, the time close, we don't need formulas, but we'll need them for duration. We'll need them for our risk to reward. We'll need them for the profit/loss, and then we'll need them to calculate our win percentage. So starting with duration, let's say the date is 11/3. Well, today is 11, November the 3rd. And let's say we traded gold and the time we got in was 8 o'clock a.m. and the time we closed was at around 9 a.m. So the question is, how do we make it so that it calculates our duration of the trade? Well, first things first, let's go ahead and highlight all of these columns and format these cells. Let's go to format and turn this into the date. Boom. So what you want to do, and I'll put it up on the screen, is type in =, if parentheses D5 equals quotation, quotation, comma, quotation, quotation, comma, D5 minus C5, parentheses, and enter. So now every time that we document our open of entry and close of price, it will pretty much calculate that duration of time. Now, this is a very crucial part because people forget about this, but this function is only working in row 5. So in order to make it so that it works for every other row, we're simply going to do what we have been doing for everything else. We're going to highlight this corner and scroll all the way down until we reach the bottom, and boom. Now we have this function on every single row. If you come to the top left corner, you can also see if the function is working right here, okay? And just like these columns, we're gonna go ahead and customize this so that all these pairs will be formatted into the duration of time. So duration, and then highlight the rest of the pairs. Come down here, and then click off. Now it should be customized to where we have the time close, and the duration. So let's go ahead and do another test real quick. Let's say we hopped in at 6:30 a.m. and we closed at 6:42 a.m. Let's see. Boom. This number is telling us that we were in the trade for 12 minutes, just like that. So the next column that uses a function is M, which is our risk to reward. So whenever you have your coordinates for your entry, your stop loss, and take profit, it's always helpful to look back on the risk to reward you were using. Was it a 1-to-1? Was it a 1-to-2? A 1-to-3? We want to make it so that the spreadsheet calculates that number for us so that we don't have to do it every single day. So for example, if we entered on gold at around 27, let's say 2787.4. Let's say our stop loss was 2787.4 and our take profit was, I'm trying to do the math in my head, 2791.6. Well, this would have given us a 1-to-2 risk to reward. So instead of having to put this number in, we want to make it so that it calculates this for us. Okay, so I had to re-edit this video because you guys will soon realize that functions are just super messy to deal with. And for some reason, it wasn't letting me add the function at the very first row. So instead, we're going to pick another column. Let's just go to 11 and work with this one, the copy for the rest of them. And I'll just briefly call it out for what it is in case you need help. So the formula is equals if parentheses J11 equals quotation, quotation, comma, quotation, quotation, comma, if parentheses G11 equals quotation, long, quotation, comma, parentheses L11 minus J11, parentheses, slash, parentheses, J11 minus K11, parentheses, comma, parentheses, J11 minus L11, parentheses, slash, parentheses, K11 minus J11, and 3 closing parentheses. Once you press enter, what we're going to do is highlight this cell and go ahead and duplicate it towards the other ones. Just like this, and then get the remaining ones just like that. So now all of these cells should have the function. So in row 6, let's say we hopped into a trade at around, I don't know, 2743.1, and our stop loss was 2740.1, and then our take profit was 2749.1. Well, our risk to reward would be 2. And notice how it was calculating that number as I was typing it in. So this is going to make your time much more useful because you don't have to waste time typing in this number. So we have our entry, stop loss, take profit, and risk to reward automated. The next column we're going to focus on is our balance. Just like the initial balance and max balance, what we're going to do is highlight these 2 columns like this and format it into currency. So now it should show up as 10K. Let's say we made a profit of $100. Cool. So for this formula, to make time more useful, I'm going to go ahead and copy and paste and just read it out for what it is. So the formula reads equals if parentheses '06 equals quotation, quotation, comma, quotation, quotation, comma, P5 plus '06 parentheses, enter. And before we test this, we have to go ahead and duplicate this formula to all the remaining cells. We're going to go ahead and go to the 1 and 6, click on the right bottom, and drag this bad boy all the way down. So let's go ahead and test this bad boy out. Let's say we lost $500. Boom, it should calculate this number, 9,500. Let's say we made a profit of 1,200 the next day. Boom, it should automatically calculate this number to 10,700. This function is the most helpful for me because I'm not the best at math. So whenever I have a certain number that I'm trying to calculate, it will automate that number into my balance, which is super helpful. So far, our trading journal is almost at 100%. We have our date, pair, time close, duration, session, long or short, contract size, entry type. We have our entry, stop loss, take profit, risk to reward, and outcome. And then we have our profit and balance. So far, so good. Now, before we move on to the last part, one thing I like to do when it comes to the time open and time closed is insert the trading view link into which I entered and which I closed as a reference. So let's say at 8 a.m., let me throw an example from my current trading journal. Let's say I wanted to insert the open in which I entered in on gold. I would come to the cell, go to insert link, and copy it right here directly from TradingView. And then time that I closed, I do the same thing. I'd get that link from TradingView, copy it, and then insert it right here. So now when I click on this link, it will show me an image in which I entered in. And same thing over here, when I clicked on the closed, it will show me an image in which that trade closed. Super helpful. All right, so the last part, we're gonna talk about how to calculate our win percentage. So for most people like me, I wanna know how I'm doing overall, what my win percentage is, so that when I have someone on Instagram or YouTube or anyone in general that I talk to ask me, hey Ace, what's your win percentage? I can provide them that information with zero hesitation. So what I like to do is come to the far right. We're gonna go to R4 and highlight these 4 cells right next to each other and make borders around them just like this. Now this will simply say win, and this will simply say loss. Just like that. Just to speed this up, I'm gonna go ahead and copy and paste the function from my current journal and explain it in a second. So the formula reads equals count if, that's COUNTIF, parentheses, N5, colon, N224, comma, quotation, win, quotation, parentheses. Enter, and it should have a 0. Now, it's not going to give you a number unless you choose an outcome. So let's go ahead and test it out. Let's say we won this trade. Boom. It should show 1. Let's say we won another trade. It should show 2. Let's say we won again and again and again. So this is now automated to where we have a number that is provided in reference to how many times we won throughout a day, week, or month period. Now for the loss, let's go ahead and copy and paste the formula. This reads equals count if, parentheses, N5, colon, N224, comma, quotation, loss, quotation, parentheses, enter, and boom, it should show a 0 unless we have documented losses on our spreadsheet. So let's say we have 2 losses, 3 losses. This number should automatically be automated. So now that we have that done, we want to go ahead and make another box that actually gives us our win percentage in calculation to how many wins or losses we have. So what I like to do is leave a space in between these 2 rows. We're going to go to R7, highlight 3 rows and stretch this out 3 columns. Let's go to merge these cells. Let's go ahead and leave a border around it and type in win percentage. You know the deal. We're gonna go ahead and center it like that. Let's go ahead and make it bigger and bold, just like, or we'll make it 12. And then down below, we're gonna go ahead and highlight 5 rows, 1, 2, 3, 4, 5, and stretch this bad boy all the way out to column T. Same thing, let's go ahead and merge them together and leave a border. So this area is going to calculate our win percentage. So of course, we're gonna need a formula. I'm gonna go ahead and copy and paste it and explain it in a second. And before we get started, what I would do is just have information that the function can rely on. So let's go ahead and throw in a win and a loss so that the function has data to work with. And the function reads equals S4 slash parentheses S4 plus S5 parentheses enter. Now our data should be calculated. So first things first, let's go ahead and center it like this and make it visible. Let's make this about 30 font, just like that. And now we have to change the format to a percentage. So we're gonna go ahead and go to format, number, percent. And we should have a 50% win rate since we only won once and lost once. And as we go ahead and put in more data, our win percentage will change. So notice how I am changing the outcome and our win percentage is fluctuating. Now for the final touches, I like to add an image to kind of stamp my trading journal so that no one can steal it from me. I'll add in like my logo or something that represents my brand. So I'll go to insert image over cells, and then use my logo. And I'll just place this bad boy up about here, right below that win percentage. So that if I want to take a screenshot, post it on my IG highlights that you guys have seen, it will be right here. Now, in order to convert this into Excel, what you want to do is come to File. Let's go ahead and name this real quick. Trading Journal. You go to File, download Microsoft Excel. Once it downloads, open File, and it should pop up right here, just like that. So there you guys have it. This was my guide to the ultimate trading journal for those that are trying to be more professional in the day trading industry. So in today's video, we're gonna be talking about news. So trading news for day trading involves taking advantage of market volatility and price movements that occur in response to news events. If you want to be a really good day trader, one thing that you have to understand is your fundamental analysis. Now, your fundamental analysis is a bit different from your technical analysis. You see, your technical analysis involves more with what and how price moved a certain type of way, whether if it was at a discount, if it was at a nice premium, if it was at a nice order block. That is the what and how of price moved at a certain location. But your fundamental analysis is the when and why. So when did price move at this given level of support or resistance? And why did it move that way? Did we have a news event? Did we have some sort of economic inflation? Did we have some sort of geopolitical volatility off of this event? That is your fundamental analysis. And when you combine your technical and your fundamental, you have a better understanding on how the market moves. So in order to have a strong understanding of your why and when, you need to have a economic calendar. Now, for Forex trading, this is the most popular website that a lot of day traders use. This is called Forex Factory, and you're going to want to bookmark this website. But we're going to talk about this and a few other websites that are pretty useful that you can use whether you're trading futures, commodities, ETFs, indices, etc. But this is like the main website that a lot of day traders use for Forex trading. So this website pretty much just informs you about global events that could potentially impact the market, whether if it's on Euro, GBP, AUD, USD. All of the currency pairs are pretty relevant for this website. Now,
One thing you guys are going to want to pay attention to are the red folders. The yellow ones, the gray ones aren't as important because they don't hold a lot of volatility. The ones that are red and orange are high impact news, which basically means they have a higher impact in the market. And this is pretty self explanatory. Like I mentioned, you have the date. So Friday, July 19th, before the market closed, it gives you the time of that announcement. So I am Eastern time. So this was at 2 a.m. It shows you the announcements for whatever pair is about to be impacted. So at 2 a.m. Eastern time, we had news for Euro and GBP. And again, you don't want to, I mean, you can read the yellow folders if you want, just to get some sort of information about whatever event is presented, but you only really need to pay attention to the red folders. So after this, we have news on GBP. It is the retail sales. And what I do is come to this little folder icon, click on that so I can get information about the event. And one thing you're going to want to pay attention to is why traders care. It gives you information on why people are looking at the news event to prepare whatever entry they're about to have. So for retail sales, it's the primary gauge of consumer spending, which accounts for the majority of overall economic activity. Now, for me, I like reading this because it gives me information on why the news event is important so that when I'm teaching a lesson about fundamental analysis, I have information to back up that news event. It's not super important. Again, you guys can just pay attention to the colors and then trade off of that. But it is also useful to have some sort of common knowledge on the news event so that when you see it again, you'll know what it is, right? Down here, we have 8:30 a.m. We have news on CAD, core retail sales. It's a red folder, so it is important. We're gonna click on the icon. Sometimes it does give you information on why traders care. Sometimes it doesn't. But you can also read the FF notes. It gives you more information. So for core retail sales, we have automobile sales account for about 20% of retail sales, but they tend to be very volatile and distort the underlying trend. The core data is therefore thought to be a better gauge of spending trends. It also gives you the preferred name, retail sales, X autos, and it gives you the source. So you can read up about the news event right here, and it will take you to the website, give you more statistics about the CAD or Canadian dollar. And yeah, that's pretty much it. Now, I kind of stopped trading volatile news only because my system or the system I use now is much more profitable, and I don't really have to rely on high impact news to find sniper entries and catch really big moves. But if you guys want, if you go to my channel, Smart Money Ace, let me try to pull it up. If you go to my channel, Smart Money Ace, I have a lot of live streams where I show you guys how news incorporates my technical analysis. And if you click on any of these live streams, you'll see that I actually spend the first, 5-10 minutes analyzing the economic calendar to see if there's going to be any high impact news for the trading period. Okay. So one of the biggest benefits of news is that you can incorporate it with any type of method or strategy into your trading system. So let's say you're trading the breakout method, right? Where you're waiting for a breakout, but price is very slow. Well, high impact news has a lot of volatility. So let's say you're at this given level of resistance or price is nearing resistance and you're waiting for a breakout to catch a break and retest into another range. Well, news, it allows price to have more volatility. So let's say we have a news event where price spikes up. Well, now you can incorporate that system because once you get that break, you're waiting for the retracement instead of waiting for a longer period of time since price was moving slower beforehand. So this is why your fundamental analysis is important because you'll be more prepared before price makes a huge move in the market. All right. And some other websites that allow you to have that feedback loop to understand the aftermath of a trade is fxstreet.com. This is a website I also use. And I think they changed their website recently because it did not look like this a few months ago. Is this the main page? Okay. So I use this website usually after my trade hits stop loss or TP, or if I'm in the middle of it, simply because I want to get an understanding of what's happening. So if we have a trade on GU and I'm trying to figure out what's going on around the world, we have right here pound sterling pullback to pave the wave for fresh uptrend. We click right here. We can get a general analysis on what's happening around the world. The pound recorded a fresh 12-month high above 1300 against the US dollar, but the GU pair snapped its 2 consecutive weekly gains to settle in the red. And then it has more information right here, which I'm not going to read. And the reason why this is important, because you guys have to remember, you're not the only person trading in the market. We have several investors that are also looking at this pair. And news, or I guess price action, is also heavily influenced by investors that are trying to figure out which way to capitalize in the market, buys or sells, right? Well, if we have a negative news event or a announcement indicating that price is going to push down, what do you think is going to happen? A lot of investors are going to anticipate price to move down. Vice versa, if we have a positive announcement where they're saying the bulls are in control or price is looking to float above a certain area, a lot of investors are going to anticipate for buys. Okay, so that's how I incorporate that website. We also have CNBC, another favorite that I use for businesses, corporations, specifically indices, when I'm trying to figure out the rate of price, whether if it's going to be negative or positive. You have your US markets, you have bonds, you have oil, you have gold, and you have the pre market, which is very helpful. If you go to the left corner and hover around markets, it will show you the options in which you can be informed either with currencies, cryptocurrencies, futures and commodities, which is a favorite, bonds, funds, and ETFs. And then the last website, I kind of stopped using this website because I had a certain strategy I used for NFP when trying to determine the sentiment of price for gold. But this is also a pretty good website when trying to figure out the rate of certain currencies, but it's not that helpful in my opinion. The main websites I want you guys to bookmark is forexfactory.com, fxstreet.com, and CNBC if you're going to be trading futures and commodities. But that's about it. For homework, what I want you guys to do is practice using this website, and I have my live streams up in case you need a reference. Practice using this website. Get in the habit of analyzing your fundamental analysis on news before entering on your technical analysis so that you can combine them both to have a really good understanding of what's happening in the market. What is risk management and why is it important? Let's talk about it. So risk management is crucial for day trading due to the fast-paced and volatile nature of financial markets. And here are 8 reasons why I think it's essential. Number 1, you have your protection of capital. Day traders need to protect their capital to stay in the game. Effective risk management helps minimize losses and helps preserve funds for future trades. Number 2, limited losses. By setting up stop loss orders and determining acceptable loss levels, traders can prevent small losses from turning into significant ones. This discipline ensures that one bad trade doesn't wipe out previous gains. Number 3, enhance consistency. Consistent application of risk management strategies leads to more stable trading results. This reduces the emotional impact of trading, allowing for more rational decision making. At number 4, managing leverage. Day traders often use leverage to amplify their gains, which also amplifies potential losses. Proper risk management ensures that leverage is used wisely and that traders are not overexposed. Number 5, we kind of talked about it briefly, and that is reducing emotional impact. Trading can be emotional, and losses can lead to irrational decisions. A well-defined risk management plan helps traders maintain discipline and stick to their strategy, even during stressful periods. So oftentimes when we have high impact news and we're not using risk management, we tend to revenge trade, over leverage, and our emotions tend to take over because we have FOMO, the fear of missing out on profit. Number 6, maximizing profit potential. By managing risk, traders can focus on high probability trades and optimize their risk reward ratios. This increases the potential for profitable trades over time. At number 7, we have surviving market volatility. So we all know that the financial markets can be pretty unpredictable, which is why risk management helps traders navigate through those periods of high volatility without incurring devastating losses. And last, at number 8, building confidence. A solid risk management plan helps build confidence as traders know they have a system in place to help protect against significant losses. This confidence can also lead to a better trading performance. So when it comes to having a system in place, one thing that I recommend and have recommended to my students is to only risk 2% per trade. That way you can accumulate a percent goal to reach for a week without having to over leverage to the point where you're over risking for that percent gain. So let's say your percent goal for the week is 10% and you're only risking 2% per trade. Well, that gives you the flexibility to enter in a trade on Monday, Tuesday, Wednesday, Thursday, and Friday, because all of those days adds up to your percent goal for the week. So on TradingView, we can go ahead and write this out so it's more visually clear. Let's say you have $1,000 in your account, okay? And your percent goal is 10% a week. So let's say you're risking 2% per trade. Or let's go ahead and write out the days of the week. Let's go Monday. Oops, that's sloppy. Let's go Monday. We have Tuesday. We have Wednesday. We have Thursday. Thursday is like, we'll do TH like that. And then we have Friday, okay? And this is your percent goal, 10%, whether if you're in profit or in drawdown. So on Monday, we take a trade where we're risking 2%. On Tuesday, we enter in a trade where we're risking 2%. On Wednesday, same thing. Same thing on Thursday. And then same thing on Friday. So if we risk 2% a day, this gives us the ability to enter in for the rest of the days until we reach that 10% cap. And this is also why I use higher ratios. So my ratio rule is a 1-to-2 or higher, because if we use a 1-to-1 on Monday, 1-to-1 on Tuesday, Wednesday, Thursday, and Friday, and let's say we lose all those trades, well, we just lost 10% of our account, right? But let's say we use a 1-to-1 on Monday and a 1-to-1 on Tuesday, but we use a 1-to-2 on Wednesday. Where did we end? Well, let's write it out. So let's say on Monday we lose a trade, on Tuesday we lose a trade, but on Wednesday we win with a 1-to-2 ratio. Well, if this is a 1-to-1, meaning that our risk to reward is the same. We lose 2% on Monday, we lose 2% on Tuesday, but on Wednesday, since we're using a 1-to-2 risk to reward ratio and we actually win, well, we just ended up making 4%. Why? Because our initial risk is 2%. So since we're using a 1-to-2, we're just multiplying that number by 2. So where do we end on Wednesday? Well, since we lost on Monday, since we lost on Tuesday, but won with a 1-to-2, we are now at break even. And let's say we use another 1-to-2, which is profitable, and then we lose on Friday. So we're at break even on Wednesday, and then we win another trade on Thursday with a 1-to-2 ratio, risking 2%. So now we're at 4, and then we lose again on Friday, which we're risking 2%, pushes us back down to a 2% gain. And this is the system that I use on a weekly basis. When I started out with 1,000 in one of my accounts 2 years ago, I was using this system to compound my account. So my weekly goal was 10%. And let's say I wanted to enter in on more trades on Monday, my cap was 2 trades. So if I wanted to enter in twice on Monday, well, instead of 2%, I would scale down to 1. So I would enter in a trade where I'm risking 1%, and I would enter in another trade risking 1 as well, so that throughout the day, my total percent at risk would be 2. So let's say you risked 5% per trade and your weekly target is 10%. You don't have to have a 10% goal, but just from my experience, what has helped me compound and grow my account, my weekly goal has been 10% each week. I'm not a financial advisor or anything like that. Do whatever you like with your money. I'm just giving you some advice that's helped me throughout my trading journey. So let's say you risk 5%. So on Monday, we risk 5%. Tuesday, 5%. Wednesday, 5%, and so on. Well, how much did we risk throughout the week? We have 5, 10, 15, 20, 25. We are far over our 10% goal. So if we lose on Monday and lose on Tuesday, we're already done for the week. We don't have any leverage to trade on Wednesday, Thursday, and Friday. And just like I mentioned at the very beginning, one of the key aspects of risk management is that it allows you to control your emotions. If you hop into a trade, you're over risking, and then you think you're gonna break even or end in profit the next day, and then that trade ends up losing, you're gonna go crazy. Okay. And it's not gonna be a good look on you, and it's not going to benefit you as a day trader when you're trying to practice discipline. So your percent goal and the percent you're risking each day is far more important than the setup that you're trying to catch. You could do something like this where you enter in risking 5%, but your reward is double. Meaning if that trade ends in profit, you would have made a 10% gain. But what did I mention at the very beginning? I think it was point 0.7. I mentioned that you want to survive market volatility. The market is unpredictable. It's not our friends. We're not holding hands with the market. This could go wrong. If you lose 5% on Monday, it's going to be much harder to get to a break-even point if your percent goal is 10. Because check this out. You lose on Monday, you're going to want to risk more to get to that break-even point. Let's say you lose Tuesday. You're now in more drawdown than you would have been if you only risked 2, which is why I emphasize that you want to use a good risk management strategy so that that doesn't happen to you. And then I have some PDFs, or I have a PDF that kind of shows you an example of what this looks like. So a account balance with 50K, risking 2%, you're only risking 1K. Here are some more examples: 49K, 980. And then this is what it looks like with 10%. So instead of 1K, you'd be risking 5K, which is a lot, because 10 of those trades, if they all go wrong, you would have blown your account. Rather than having that 2% gain of 1K, you'll be just fine. And this can look pretty intimidating for those that have a low number in their balance. If it's not at least 5 digits, you might be thinking that 2% isn't a lot, but I promise you from experience, I promise you those numbers add up. When you're able to compound your account with risk management and not having to hope to catch a big win, your account is going to grow over time. And once you get to the point of having 10K in your account, I mean, 1% is well enough. So the next thing I want to talk about are the resources for risk management. If you're not good at math, or if any part of this video confused you, there's actually a free website that I've been using when I first started that's helped me. So if you go to babypips.com, and I'll leave the link in the description. So if you go to this website, scroll all the way up and go to where it says tools and then position size calculator, it gives you a free position size calculator, which you can use before you hop in a trade. So you have your amount in currency, which is USD. Let's say your account balance is, we'll do the same example, 50K, 1, 2, 3, risk 2%. You would put your stop loss in pips. Let's say it's 20, and then you would calculate it. And then it gives you all the information you need. So the amount you'd be risking is 1K, and the lot size you'd be using is 5. Now this part kind of confuses me, where it says standard lots, mini lots, micro lots, which is why I use a different app, which I'll show you guys as well, called Stenu. And it's just basically more convenient when I'm on my phone. But it gives me the exact number in terms of the lot size to put in before I enter in the trade. So in this example, we have 50K, risking 2%, stop loss is 20, and then it also gives you the currency pair, or you get to choose whatever currency pair. Let's say in this example, we are also doing Euro USD, calculate. So yeah, I would be using I don't know if you guys can see that. Let's see if it focuses. Maybe if I put my brightness down. Can you guys see that? I'll just screenshot it. It basically tells me the lot size I'd be using. So I'd be using a 5 lot. And I guess it does tell me that here as well, but I don't know why it has all these other lots. Let's do another example real quick. Let's say we have 1,000 in our account, risking 2%. And let's say our stop loss is 10. Calculate. So in this trade, we would be risking $20. And our lot size would be 0.2. Let's see if that's accurate. So account balance, 1,000, 2%, stop loss, 10. We said Euro USD, calculate. So yeah, it is accurate. Never mind. So I'd be using a 0.2 lot size, which is a mini lot. And that's all I have for today's lesson. So in conclusion, by adhering to the 2% rule, day traders can effectively manage risk, reduce the likelihood of significant losses, and increase their chances of long-term success in the markets. For homework, what I want you guys to do is practice using this website. I also want you to bookmark this website so that it's in your convenience when you're about to hop on TradingView or entering on a trade. And yeah, that's about it. So the first smart money concept we're going to talk about are order blocks. So order blocks are areas on a price chart where institutional traders, like banks or hedge funds, have placed large buy or sell orders. These blocks or zones often indicate areas of strong support or resistance and they can provide valuable information about potential future price movements. So here I have some key features of order blocks that I want to quickly go over. Number one, you have institutional activity. So order blocks are usually formed by large volume orders placed by institutional traders, like I mentioned earlier. These traders often have more information and resources, making their actions significant indicators of future price movements. So I think I mentioned this at the very beginning. As retail traders, we are trading against the institutions, the banks, the hedge funds, the people that have access to more resources, which is why I love day trading, because retail trading is for the public. We have the privilege to catch these moves, these algorithms as these big boys, right? So these order blocks contain high volume activity from these institutions where they have all these orders placed and set in stone throughout that trading day period. The second key feature is price consolidation. So order blocks are often seen in areas of price consolidation where the price moves within a tight range before breaking out in one direction. This indicates accumulation or distribution of assets by institutional traders. The third key feature is support and resistance levels. Just like most concepts, order blocks also create significant support and resistance levels. When the price returns to these levels, it often reacts strongly, either bouncing off or breaking through the level. So if you think about some earlier concepts we talked about, like the break and retest, or even talking about a ranging market, you have a zone at which price is respecting, but eventually breaks out of. Same thing with order blocks, right? You have a large zone that price is respecting for a long period of time, at which you can catch some really nice entries for a continuation from previous price action. And the last feature is high volume. So order blocks are associated with high trading volumes, indicating significant interest in activity at these price levels. So how do we actually identify these order blocks for our everyday trading? So the first one is being able to identify previous highs and lows. The second one is being able to identify some sort of engulfing pattern. The third one is being able to identify some sort of volume spike. And the last one, which I think isn't too important, and I'll explain why later, is market structure breaks. All right, so let's talk about each one real quick. So previous highs and lows, what does that mean? So order blocks can often form around previous highs and lows where institutional traders may have placed large orders. You're basically just trying to identify some sort of structure. If you think about the Fibonacci retracement, one cannot say it's a fib setup without having confirmation of previous structure. Same thing applies for an order block. Let's say you are placing your zone at this area at which you think price is going to hold. Well, if you have previous structure of lows making a pit stop in that zone, well, there's your confirmation that that might be a valid order block. Second one is engulfing patterns. So large candlesticks that engulf previous candlesticks in a consolidation area can indicate that the presence of an order block may be forming. Why? Well, if you think about price consolidating, what's happening? There's a lot of orders being placed given at a level of support or resistance. So if you have a engulfing pattern that engulfs those previous candles, well, there could be room for price to flow and eventually make a retracement back down to that zone. So that's why, in my opinion, it's important to look for some sort of engulfing candlestick that indicates there's a pattern that might be set in stone for the next couple of minutes, hours, days, etc. For the third one, we have volume spikes. Spikes in trading volume often accompany the formation of order blocks, signaling heavy trading activity. So, like I kind of mentioned before, any type of engulfing pattern kind of indicates a lot of volume in the market. Same thing with spikes, either from news, if there's an event in the market. A spike in the market or any type of push can form some sort of imbalance in the market at which price has to eventually fill. So, let's say if you're at a given area where it's consolidating and all of a sudden price starts pushing up and forms some sort of imbalance, well, price eventually has to fill that market gap. So, if you're able to identify some sort of spike in the market, you can predict that that area at which price pushed off could be considered some sort of order block or supply demand zone that price is going to eventually make its way back to to react off of in the future. So now let's go ahead and hop on TradingView and try to look for some examples. So with order blocks, one thing I like to do is scale all the way up to my daily time frame and find key zones in the market at which I think price is going to react off of for that day period. So for example, on gold, price is pretty choppy right now. We don't really have a lot of structure indicating what type of market we're in, either an uptrend, downtrend, or range. But if we come down here, looking at all of this cluster, well, before we had all of this, we had this nice push into this range, and then price started to react off of these lows. So if I go ahead and get my rectangle tool and place it from that push, that previous bearish candle and out, notice how we have a touch right here, we have a touch right here, and we have a touch right here. So this right here would be my daily order block because I'm noticing that we have a lot of orders being placed in this zone, which is why it's called an order block. So eventually, when price makes its way back down to the zone, I can anticipate price to react in a positive way, or if it has a breakout, it would react in a negative way. Negative meaning sells, positive meaning buys. Not saying that sells are bad. That's just how I think, okay? And then we would target our next order block. So we would look for the next zone that price is more than likely going to react off of. And like I mentioned before, one of the key features are spikes and engulfing candlesticks. Well, this engulfs the previous one right here. And we also have a spike at which price has all of these consecutive bullish candles right here. So we would draw, oops, that was a mistake. So we would draw our next zone right here, just like that. This concept is pretty simple, and I wanted to start with order blocks because they're not as detailed than maybe supply and demand and liquidity sweeps and fair value gaps and all of these concepts you hear. We're gonna get more advanced throughout the week, but starting with order blocks, this is more of a general zone that you want to try to identify, saying that, hey, I'm placing my bet that most institutional traders have orders or they have a watch at the zone anticipating price to react off. And one thing I don't want you guys to confuse yourself with when we talk about more smart money concepts, order blocks are not the same as supply and demand. I like to look at my order blocks as the overall zone that price might react off of for a day on a higher time frame, and then supply and demand are usually smaller time frame areas that price is reacting off of, 15-minute, 30-minute, 1 hour, etc. Okay. And this works on almost every financial instrument, Forex, commodities. We have futures as well. Let's just see what we can find. So my daily time frame, I'm going to do this from scratch. What are we noticing? Let's go ahead and scale out real quick. Where is price at? So if we look at this channel right here, what do we see? Well, price is pushing down, but before we get this nice push right here, I'm noticing this bearish spike. We can draw out a zone from that previous bullish candle, scale it out, and what happens? Price makes its way back up. We have a touch right here, and we have a touch right here. So this would be considered as our bearish order block or daily bearish order block, since most people are looking for sells once price makes its way into the zone, okay? Very simple. And then within these zones, you can actually scale in on the 1 hour and try to find some setups. Knowing that price is going to more than likely consolidate in this range or zone, not only do you have confirmation that, hey, price might actually sell, but you have a safety net in case price does decide to break. This is no longer relevant, right? But let's say if you're in this area and price is pushing up, well, on your daily perspective, like we talked about on top-down analysis, since we have a zone that price is more than likely going to respect a bearish order block, instead of looking for buys, you would be looking for sells. Let's look for another example. On S&P 500, let's see. On the S&P 500, I'm noticing that price is trailing up. We're in a nice bullish trend. And one concern that many might have is, well, if we don't have previous price history, where will we draw our zone? So notice how I scroll to the left. I don't have any indication of price making another touch at an equal high or equal low. So how would I draw out my order block? And that's a good question. Well, most of the times, a lot of people try to focus on previous price instead of working with current price. With current price, if we scale in, what's happening? Well, look, we have these nice consecutive candles after an engulfing bullish candlestick. So what is the market creating? Some sort of imbalance. So if we take our rectangle tool place it from the bottom of that previous bearish candle to the top and scale out like this, we have a daily order block. We're working with current price. So we scale on the 4-hour. Notice that price is nearing that level. It's not quite in there, but we can say that price is simply forming some structure to have a continuation. So this is the zone I would be working with. And again, I don't like to call these supply and demand areas unless I scale in lower than the 4-hour to see these micro patterns. But for an overall daily perspective, as if I'm using top-down analysis, I'm simply going to try to find one zone to work off of to identify as an order block that most people are looking at as well. I was going to save this for my advanced course, but within order blocks, I have 3 concrete levels that I would eye out for. I'll briefly explain it, but I don't want to go too deep because I don't want to confuse the beginner trader or average trader that is trying to learn smart money concepts. But basically within every zone, and this also works with supply and demand, you have your highest point of interest, your 50%, and then you have your lowest point of interest. Basically, if you ever tune into one of my live sessions and I say, oh, price is going to react off of the highest point, lowest point of 50%, it's just the level at which price is going to stop and actually start trailing back up. So notice how price kind of touches our highest point of interest before pushing back up. So in this scenario, I would have my stop loss below the 50%. Now, if price made its way to the 50% level, which is the middle, I would put my stop loss below my lowest point of interest. And if price made its way to the lowest point, I'd put my stop loss outside of the zone. So imagine if I'm looking for buys, I'd place my, let me put this back up. I place a buy order like this. And if price made its way to the 50%, I'd place my stop loss below the LPI and outside the zone. And if price made its way to the lowest point of interest, I'd actually look for the nearest level of support like that. Okay. That way, my stop loss is at a safety position in case price decides to reject our bias. All right. And I also have some PDFs that should help you guys get a general understanding of order blocks. So right here we have order blocks are footprints left by the market when an impulsive move occurs. Order block OB is the last candle before the strong move that creates an imbalance in the market. So just like in this image, notice how price makes a huge push in the market, creating some sort of imbalance, indicating that price eventually has to make its way back to correct the market. So they're simply placing that zone before that previous push off of that bearish candle like we did on the examples, and then pushing that zone out. And this would be considered a bullish order block because you're looking for buys once price makes its way back into that zone. Very, very simple. And then what's this? So we have an example of a bearish order block where we get that nice bearish push, and then we're placing that zone from that previous bullish candle, expanding it, waiting for price to make that retracement, and then we're entering for sells. All right. And that will do it for today's lesson. Hopefully this video wasn't too confusing. I tend to talk really fast sometimes when I'm explaining smart money concepts, but if it's confusing at all, please let me know in the comment section and I'll be sure to provide more examples in the Discord. For homework, what I want you guys to do is just practice identifying your daily order block levels so that you have a good eye in the market at where price is probably going to respect. But that has been order blocks. So in today's video, we're going to be talking about supply and demand. Now, this is one of my favorite smart money concepts because I use it every day on almost every time frame to catch some really good entries. And honestly, this might be the most valuable smart money concept for you to use on your day-to-day entries, whether you're trading Forex, whether you're trading futures, indices. It works on all financial instruments. It's very simple. And once you get a good understanding on how this works, you're going to be able to find a lot of good moves in the market to capitalize on. So let's go ahead and get started. In day trading, understanding supply and demand is crucial as it directly influences price movements within short time frames. Supply is the quantity of an asset available for sale at a given price. High supply typically drives price down. So supply, just like resistance, is usually above price, where price makes an indirect touch with that zone to push price down. High demand typically drives price up. Now, if we're solely talking about economics, right, let's ignore trading for a second. If you think about supply and demand, the cost of a product, if it is in high demand, what do buyers do? Purchase, right? Price goes up because it's in high demand. If it's overbought, meaning there's a oversupply of goods, what happens? Buyers, investors tend to sell because there's oversupply. So they're looking for a return off of a discounted price. If demand is high, meaning there's a lot of demand in the market, let's say the PS5 for an example, a lot of people are going to want to buy that product. And then vice versa, if there's a oversupply, that product tends to lose value. And what happens when something loses value? Investors, general consumers tend to sell. All right. Just keep that in the back of your head because oftentimes a lot of people get confused with supply and demand, whether if it's the anticipation that price is going to push down or the anticipation that price is going to push up. Excuse me. So in day trading, we incorporate this information into zones in which we anticipate price is going to react off of. So for supply zones, these are areas on a price chart where selling interest is strong enough to overcome buying pressure, leading to a price decline. Now for demand zones, these are areas where buying interest is strong enough to overcome selling pressure, leading to a price increase. All right. So if we take a look at this PDF that I have right here, this is what supply and demand looks like. So we have a lot of selling interest and then we have a lot of buying interest. And just like order blocks, these zones are typically marked up after experiencing some sort of volatility in the market. So notice how we have these bearish consecutive candles and then we have this bearish candle right here. We have these consecutive bullish candles and notice how they carry a lot of volume. Why? Because there's a significant push in the market that creates imbalance. So what happens? It creates a point of interest in which sellers are anticipating price to sell at this supply and buyers are anticipating to buy at this demand. And just like any other concept, you can incorporate this towards any type of strategy. So the break and retest, notice how we have a break through the zone and then what happens? It makes a retracement to that HPI and then pushes back up. So how do you identify these supply and demand zones? I have 4 points when identifying these zones, which I think are helpful. So starting out with number 1, we have price action. At number 2, we have volume spikes. At number 3, we have candlestick patterns. And the last one is support and resistance. Very, very simple. And I'll briefly explain each one in a second. Let me just type this out. Resistance. At number 1, we have price action. Basically, pretty self-explanatory. You're just looking for some sort of significant push to the market where price movements are preceded by consolidation. At number 2, we have volume spikes. High trading volume at certain price levels can indicate strong supply or demand. At number 3, we have candlestick patterns, reversal candlestick patterns such as the engulfing, pin bars, morning star, evening star at significant price levels can highlight supply and demand zones. And at number 4, we have support and resistance. Previous support and resistance levels often align with supply and demand zones. Now, the only difference between supply and demand and support and resistance is that support and resistance is more strict at given ranges, whereas supply and demand is more of a general zone in which price may consolidate a little bit, might fake out, might reject off of, where it can hold for a longer period of time. I don't use supply and demand or the concept of supply and demand on my daily time frame or higher because I simply substitute that wording with order blocks, a general zone on a higher time frame in which price is going to react off of. But let's go ahead and look at some examples. So what I'm gonna do, I think I did this in I think it was in week 1. I'm gonna pick a random area in the market and we're just gonna talk about it. So let's go on the 2-hour time frame. Let's go ahead and get the replay button and I'm gonna scroll. I'm gonna close my eyes. Click on a random spot. All right. We're going to work with this area. Now, with supply and demand, just like any concept I talk about in this course, you want to try to incorporate everything. So top-down analysis, your ranges, you want to incorporate your candlestick patterns. All of these confluences add up for a strong entry. But in today's video, I'm simply going to focus on supply and demand alone. But what I think I'm going to do next week when the market is open, I'm going to trade live day to day for a week and see how these concepts work. I might put it on YouTube or I might just keep it in Discord. I'm not sure yet. So on Euro JPY, if we come to this area over here, right? What do we see? Well, first things first, I can clearly see that price is divided into two ranges. It was doing its thing for some time over here and then had a nice break. And then it had a slight retracement, not quite at that newly formed support, but then decided to push up, right? So now we're working with this. Let's go ahead and scale it on the 1 hour. So one thing that I'm noticing is that the market formed some sort of gap that it reacted off of at this level. I'm gonna go ahead and use this rectangle, scale it down to the zone, and now we can call this demand. Why? Because we have some sort of buying interest in which price reacted off of. So if anything, I'm anticipating price to make another touch for another push. So I get my long position, place it right here. And then we want to go ahead and drag our stop loss to the previous resistance or newly formed support, which is right here. And then we can go ahead and drive our TP at the nearest resistance, which would be around here, making this a nice 1 to 2. Let's go ahead and press play and see what happens. All right. So as you guys can see, price never made its way back down to our demand. And that's okay in most scenarios. I mean, the worst thing that could have happened is that we entered in a trade and lost, but price never made its way back down to our demand. What did it do? It trailed up, it broke into another range. Notice how it passes this level of resistance, making this our new support. We have a touch right here, we have a touch right here, and we have a touch right here. So what I would do whenever price breaks into another range, this being our second one, this being our first one, I would try to look for new areas of support in the, I'm sorry, I would look for new areas of supply and demand because price is nowhere near the zone anymore. So let me go ahead and remove all the drawings real quick. Let's go ahead and see where price is at. All right. So working with this area over here, I'm noticing that price had a nice push and engulfing candle at around this area. And we had some previous consecutive bullish candles before we get that nice push. So I would take my rectangle tool and draw a level or zone of demand right here. And this touch right here at this HPI would confirm that price is holding at the zone. So if price makes its way back to our demand zone, we can anticipate for more buying interest. Let's see what happens. Okay, so this is actually current price. Wow. Wait, is it? No, it's not. So I would take my long position. Let's go ahead and put a trade right here. Stop loss at our previous support right here. And we'll make it a 1 to 2. Let's see what happens. All right, and the trade is activated. Now we want to see if price is going to hold this zone. Right now, it's not looking like it is because price is closing below. If anything, it looks like it's going to react off of this previous zone. Let's just see. All right, let's go ahead and talk about what just happened. So price broke through our previous zone that we had marked up. So we would have lost this trade. And this closure below the zone would have confirmed that it's not accurate. So we can go ahead and delete this. And what happens over here? Price makes a push where we could have entered in at this nice 50%, capitalizing on a few pips. This would have been a good 60, 65 pip move. And then it finally breaks through, performing some sort of breakout because we didn't quite get a closure below. And then what happens? It pushes back up. So this was a really good example, in my opinion, because it shows you that supply and demand isn't perfect. You're not just going to win every trade. Sometimes there's more to it. In this case, price was directed towards a previous zone off of this nice consecutive push we had right here, creating some sort of imbalance that price eventually filled, right? Because we had all of this. This whole area got filled, right? So what did price do? It came down, we had a nice push, and then it came back down again, but didn't quite close below and made a second push. And as we continue, I just want to see at which point in time does this zone get broken. Let's just see. So boom, eventually our zone gets broken. So we have a nice push, we have a break, we have a retracement, and then price is pushing off of that newly formed supply. And let's just see if it reacts off of this zone right here. We get a touch. Let's see if it pushes down. Beautiful. Beautiful. Just like I anticipated, I cannot make this up. I'm glad this happened because when you do get a break of structure, when price breaks a zone, you don't want to just delete it because price failed. You want to keep that up for the day or trading period in case price makes a retracement, the break and retest, right? We had our demand set in stone. Price was consolidating a little bit. It finally broke through, closed below, had some time to trail in its new range, right? And then what did it do? It finally came back up and reacted off of this newly formed supply. Beautiful, beautiful, beautiful. And I want you guys to notice that I am on the 30-minute time frame, so you can use it on lower time frames, but I wouldn't go anything under the 15-minute. Let's go ahead and look at another example. Let's look at gold. This is my favorite. So let's go ahead on the daily time frame first. This is from yesterday's lesson. Let's remove everything. Let's get the replay tool and pick a random point in the market. So I'm closing my eyes, closing my eyes. Let's click right here. All right, so on gold, this was 2021, 2022, January. Okay, wow, we scrolled for some time. Let's go ahead and scale in on the 1 hour or 2 hour, excuse me. Let's see what we see. So first things first, what I'm noticing is that price is reacting off of this level right here. We have a nice push in the market. We have these consecutive bullish candles over here, forming some sort of imbalance. Let's get our tool, go ahead and scale the zone out from that previous push or before that previous push of that bearish candle. Let's work with previous price. Let's scale in on the 1 hour. Let's see what's going on. So price is reacting off that level. So if I was in the market right now, if it was active, I would try to hop in. If I was solely just trading supply and demand, what I would do is try to catch this move back up to that newly formed resistance after performing some sort of break, right? Because this is range 2, or we can say this is range 2, this is range 1, because we have some touches dividing these ranges over here, okay? So let's just see what happens. Solely just trading supply and demand. Then I would drag my TP to that surface, which would be a good 110 pips. And then my stop loss would be below the zone. We'll make it a 1 to 2. I just want to see what happens. Okay, so price does overall respect the zone, but we do unfortunately get tapped this huge wick right here. And there is a reason why this happens, which I'll explain in the next video. It has to do with a term called liquidity, but I'm not going to talk about that in this video. But oftentimes when you're at a pivotal point in the market where there's a lot of consecutive touches, where you see a lot of candlesticks grouped up, there's a lot of orders being placed. And if you think about the market, it's attracted towards any sort of value. So the market or the candlesticks are usually attracted towards areas that hold the most liquidity because they're taking people out of the market. And what happens, that area between your entry and stop loss holds some sort of liquidity, and liquidity equals value. But notice how price overall respects the zone, pushes up, and then TPs would have been smacked. And then it makes another push back down. Let's just see what happens. I want to see if it respects this zone or breaks into another range. So it breaks into another range, yep, and it starts to do its own thing. And this zone would be irrelevant since it's in a new range. We would go ahead and delete this and try to mark up a new zone of demand that price might react off of, which it did right here. Notice how we get this nice bullish touch, or this bullish wick, excuse me. All right, for our next example, we have T-bond futures. So let's see, let's go in the daily time frame, clear this up. let's go ahead and do the same thing. I'm gonna go ahead and close my eyes and pick a random point in the market. I'm closing my eyes, closing my eyes, closing my eyes. Let's go right here. All right, so we're in the daily time frame. Let's go on the 1 hour. Let's even go on the 15-minute. I want to see if we can try to. Oops. All right, I don't know what just happened. Let's go ahead and go on the 50-minute time frame. I don't think I can. All right, I don't know why it's not working. We'll go ahead and stay on the 30-minute. So in the 30-minute time frame, what do we notice? Well, the first thing I'm going to try to identify is a impulsive candlestick. So if we're working with current price, notice how we have these nice bearish consecutive candles next to each other. And before we get that push, we can go ahead and classify this zone as some sort of supply. And let's just see what the market does. We want price to make its way back up, react off of that HPI, 50%, or LPI. So I'd get my short position. I place it above that previous resistance, which is around here. And then I make it a nice 1 to 2. Let's see what happens. Okay, so we actually missed this move. Price reacted off of that HPI, and I kind of drew this zone incorrectly. We want to make it precise just at that bullish wick. And notice how price reacts off of that surface. We get a nice touch right here, and price pushes down. So if we caught this move, ideally, our stop loss would be at that 50% level. And then we would have drew this down to around here for our take profit, making it a nice 1 to 3. And we would have experienced zero drawdown. Now, I'm glad I was also able to show you guys this specific example because sometimes you'll have a good zone drawn out on the market, but price doesn't hit your entry. I don't want you guys to get in the habit of deleting your zones if things don't go right, because who's gonna have to say price is gonna react off of this zone later on? So let's just go ahead and press continue and see what happens. Price is doing its thing. So boom, price makes its way back to the zone. And now we're seeing if price is going to respect this zone or break into another range. Let's go ahead and continue. It sells for a bit, then pushes up. And what I want you guys to notice real quick is that it's forming some sort of bullish structure. Why? Because we have some form of support and resistance right here where price clearly makes a break and retest. It breaks to the upside, taking out this previous high, makes a retracement to our newly formed support and pushes up. So when you see something like this, you'll have a better chance of catching a retracement if price decides to continue to push and have a retracement outside of that zone. So let's go ahead and continue, see what happens. We want to look for a closure above. Boom. We have a nice bullish candle that opened above. Let's just see if it closes above. It did. So what I would do is anticipate price to have a retracement to that service of that newly formed demand. And I would scale all the way up to our newly formed resistance right here. So I'd get my long position. Stop loss. Now, how I trade might be different with how you guys use this concept, but I always like to have my stop loss outside of the zone, just in case price makes its way back to a 50% level or LPI, so that we have a chance to make some profit. And then we can go ahead and scale up, making this a 1 to 2. Or let's not be greedy. In this scenario, I'd actually have to make it pretty tight, like this. Okay, perfect. Now let's see what happens. Okay, so price makes its way back to our entry, and now the trade is active. And TPs are smacked. Beautiful, beautiful, beautiful. You love to see it. You love to see it. Now, although I was, and let's just see what happens in the future. Okay, and then price starts getting a little tacky, but anyways, going back to where we were, I want to make it very clear that Although I did use the simple concept of supply and demand, you don't want to trade solely off of this concept. One thing that could have helped me was top-down analysis, identifying an overall perspective to help me find a bias. Um, I think for me, I got lucky because I was able to identify this over here, which was a break and retest for a bullish continuation. If I didn't see something like this, I would have anticipated price to make another touch right here and then sell for a longer period of time. So that simple confluence, that break and retest, it seems so small, but in this scenario, I would have avoided a huge loss in the market. So those small confluences build up for a strong confirmation that, hey, price has a better chance of having a breakout since we're in a continuation to form some sort of retracement instead of price making another touch. And once you really get into the habit of understanding how price moves, you'll start to realize that it's not about winning or losing. Like what we talked about in week one, where people think trading is gambling. It's more what's the word? It's really about statistical significance. I like that. Statistical sniff. I gotta write that down. God damn. It's about adding up these clues and gathering all this information, whether from news, events, smart money concept, whatever you want to call it, to find these high probability setups. Okay. This is a very great lesson. How many examples did we cover? One, two, three. Okay, I'll leave it at that because I don't want this video to be too long. For homework, what I want you guys to do is just practice finding your supply and demand zones on lower time frames. Just remember that supply is when the market is in interest for sells, and demand is when the market is in interest for buys. Liquidity refers to the ease with which an asset can be bought or sold in the market without affecting its price significantly. In other words, a highly liquid market allows large orders to be executed quickly with minimum price impact. So why is this term important when it comes to trading? Well, here I have some 4 simple pointers that I want to talk about. Well, number one, you have ease of execution. High liquidity ensures that trades can be executed quickly at a desired price, which is essential for day traders who rely on rapid entry and exit. So the ease of execution plays a huge role when you're trying to enter in at a certain time, if it's a quick move maybe from a news event. And oftentimes what happens is that price may be a little delayed at a given point or desired point in the market that you're trying to enter in because that market isn't as liquid. At number 2, we have reduced slippage. So slippage occurs when a trade is executed at a different price than expected due to market movement. High liquidity reduces slippage, allowing traders to enter and exit positions closer to their intended prices. So kind of like how I explained earlier, um sometimes, and it's not as common as most people think, but sometimes you'll be at a point in the market where you think it's correlated with your broker at the same time, but because that market isn't doesn't contain a lot of liquidity, it can sometimes be delayed. So the slippage usually occurs when a trade is executed at a different price point. Number 3, we have lower transaction costs. So this isn't as important, but it's just something to keep in mind. When you have minimal slippage, it results in lower transaction costs, enhancing overall profitability. And at number 4, we have efficient price discovery. High liquidity contributes to efficient price discovery, meaning prices more accurately reflect the true value of an asset based on supply and demand. So in summary, liquidity is a vital aspect of day trading, influencing the ease, cost, and efficiency of trade execution. High liquidity ensures quick and cost-effective trades, minimal slippage, and accurate price discovery, all of which are essential for the fast-paced nature of day trading. So on the price chart, how do we actually identify areas of liquidity, and how is it relevant to our everyday trades? Well, let me go ahead and draw this out. Let's say we were in a range, right? We were in a nice range and price was consolidating in and out just like this. Just like this. Well, what do we know about a range? Or when is a range classified as a ranging market? It's when price is bouncing in and out from support and resistance. This being our support, this being our resistance. Now, liquidity are areas in the market that contain value, invisible areas in the market that hold some sort of value that traders or institutions are looking to grab. Why? Because we are literally trading against these big fish who are trying to make the most profit. So back to the chart, let's just imagine that price is at around this area right here. What do you think is going on in the market? Are people buying or selling? Well, if we're in a range and we know that price already made a recent touch right here, we have some sort of confluence saying that, hey, price is more than likely going to react off of this strong level of resistance and push down. So a lot of people are hopping in for sales, right? They're hopping in for sales right here. Price makes another touch right here. They're hopping in for sales again. Remember, it's not just one person. A lot of people around the world are hopping in the market for sales. And then we have some entries over here, right? And then they would scale their TP all the way down to this level of support. So we have a touch right here, touch right here. People are hopping in right here. People are hopping in right here. We have about 4 touches in the market. So that area between your entry and stop loss, what do you think it contains? If you said liquidity, money, or value, you are absolutely correct. So we get our emoji. We can go ahead and just place this money sign right here. There is a lot of money floating above this range, liquidity. And this is actually going to pivot into our liquidity grab lesson, which I was going to talk about later, but it's all relevant. Because eventually, what happens in a range? Does it continue to range for a long period of time? No. Eventually, price is going to break out either to the upside to start a bullish trend or downside to start a bearish trend. But how do we determine what direction price is more than likely going to break out to, the downside or upside? Well, let's talk about the downside real quick. Notice how we have a touch right here. And let's say price breaks in like this. We have a break and we have a small retracement before it pushes back up. We also have a touch right here where people are hopping in for buys, right? Over here, people are hopping in for buys right here. Well, yeah, some could say that we also have liquidity floating below. But do we have more liquidity from the downside or upside? Well, let's count. We have 1, 2 touches below price, and we have 1, 2, 3, 4 touches above price. So where do you think price is more than likely going to be attracted towards? An area in the market that has less liquidity or an area in the market that has more liquidity? Now, although we do have liquidity floating above a given range or below a given range, it doesn't necessarily mean price is going to break out right away. Oftentimes in the market, what happens is price has a liquidity grab and then pushes back down to its given respected area. And oftentimes these grabs are identified by long wicks. 9 times out of 10, that wick is simply grabbing accumulated orders floating above or below a given zone. For example, if we look at NASDAQ and we come to a random area in the market, okay, perfect. Let's look at this set of price action right here that I have boxed in. What do we notice? All right, so the first thing that I see is this consecutive push to the market. We have these nice bearish candles back to back. So price is more than likely breaking structure from a previous zone that we can identify right here as our newly supply or supply zone, 1 hour supply zone. And let's see what happens. So price makes a touch right here, respecting our supply, and makes a touch right here before pushing back down. Now, this is the reason why I use supply and demand, because notice how we are still respected in that zone. Let's go ahead and delete this and say we were simply using support and resistance. What happens? We have this nice break. We have this nice retest, and then it comes back up for another one, but price doesn't close above. What does it do? It wicks off and continues to push down. And I'm actually glad I was able to show you guys the difference between supply and demand versus support and resistance, because most retail traders who don't understand the concept of supply and demand stick with these lines. But for this example, let's just say you were using support and resistance. So you wanted to capitalize on a second push. Let's say you enter in for a sell, right? Let's go ahead and get a replay button. Let's say you're anticipating price to make another touch at that newly formed resistance. You enter in for a sell. You have your stops above like this. And let's say you wanted to make it a nice 1 to 3. If we continue, trade is activated, but we get stomped out. Now, this wick right here is a good example of a liquidity grab. Why? Because we have this nice breakout in this retracement where a lot of people are hopping in for sells, right? A lot of traders around the world are hopping in at this point because they understand the simple concept of a break and retest, where price has a nice break of structure, taking out this low, coming back up for a retracement for sells. So we have a lot of sellers hopping in right here for a 1-to-1, for a 1-to-2, 1-to-3, doesn't matter. In that area between your entry and stop loss holds some sort of value that wants to be taken out by the flip side. Because think about it, what happens when we lose a trade? What happens when price hits our stop loss? Does it just vanish? Who takes our money? It's the other side. The people that understand that retail traders use simple concepts like the Fibonacci retracement, therefore, they can eye out specific areas in the market to take advantage of these traders. And this is actually called a stop loss hunt as well. This is what these big boys do. I like to say big boys for some reason. I don't know if that sounds zesty, but when I say big boys, I'm referencing the institutions, the hedge funds, etc. So this bearish wick right here would have taken out all of these orders accumulating in this area before eventually pushing back down. If you are going to trade simply using the break and retest or even Fibonacci, make sure your stop loss is at a nice given point in case we have a stop loss hunt or liquidity grab before price continues to push back down, because you'll see this happen all the time. Let's see if we can find another quick example just going left of price. Let's see. Let's go on the 2-hour. Okay, boom. Here's another example. So on NASDAQ, let's just say we're looking at this area. Notice how we have a nice gap where most traders are anticipating for some sort of buy interest once price makes its way back down. And then we finally get a push down into this range. So although price isn't necessarily having a strong liquidity grab because these wicks are pretty congruent with each other. We have a wick right here, wick right here, wick right here. Notice how we have all this impulsive action after we have a break of structure. Now, usually when you have a lot of orders floating above a zone or given area in the market, such as this one, where we have a lot of interest right here because people are placing buys, although we don't get a liquidity grab and then push back up into range 1, let me write this out so it's not confusing. Range 1, range 2, we'll say this is range 3. Why not? So although we don't get a respected touch where price pushes back up into range 1, we do get a nice impulsive move down into range 2 with consecutive bearish candles. So sometimes instead of having a liquidity grab, it's simply going to push down to the market with high volume. And as you can see right here, we have these nice consecutive candles indicating that there was some sort of volume that was attracting price to push down. Okay. And let's say people are placing their stop loss over here, right? We have more people hopping in right here. All of this liquidity floating below the zone was taken out by these candles, okay? And I have this PDF right here to show you guys visually what a liquidity grab is, if that example that I showed you guys wasn't clear enough. So we have a nice area of price where we have a touch right here, we have a touch right here, touch right here, and then notice how we have another touch, but this wick takes out these previous buyers. We have another example right here where price was consolidating below this level of resistance. We have a touch right here, touch right here, touch right here. And then eventually price has a nice push, taking out these orders before pushing back down. Now, if you notice, these candles aren't wicks, right? So what do we call this in trading? A lot of people will call this a fake out, which it is, because you'll assume that price is getting ready to break and have a nice continuation because we do get a break and retracement with this bearish candle closing above that level. But what does price do? It comes back into our previous range and continues to push down. So I like to consider this a fake out if it's not a wick, because it's literally faking us out. It's juking us. It's like, oh no, you thought I just grabbed these orders, now I'm pushing back down into that previous range. And then here's more examples of liquidity, how you can eye out liquidity in the market when there's a gap like this, where a lot of retail traders are obviously anticipating some sort of sell. This is where you can find some sort of liquidity. And if you notice, if I zoom in, I'm not sure if you guys can see this, but that wick technically does take out those previous sellers before pushing back down. And then let's say you're in a trend where you have a sideways channel, but you have these touches right here, right here, right here. It still works with a declining trend. It doesn't just work with support and resistance, okay? Or sideways trend, excuse me, because you have a lot of retail traders using retail concepts like I know there's the hedge where you're waiting for price to break the triangle. All these retail concepts that we use every day, These institutions know this, so they take advantage of the things that we know and see so they can take out our orders, which is why the other terminology is a stop loss hunt because they're hunting our stop loss orders. And yeah, that's pretty much it. I think these two examples were pretty solid, and I don't like to make my videos too long. But if you guys need more examples like this, let me know or join the Discord. I do this rinse and repeat every day from Monday through Friday. But if nothing made sense in this video, just comment and I'll probably make a part 2 sometime in the future. All right. So in closing, a liquidity grab is a tactic used by large market participants to trigger stop loss orders and create temporary price movements that they can exploit. Understanding liquidity grabs helps day traders avoid being caught in these moves and eventually capitalize on the ensuing price reversals. By recognizing patterns, analyzing volume, and understanding market context, traders can better navigate the fast-paced dynamics of day trading. So in this video, I'm going to define what a fair value gap is and how to identify these gaps in the market. So in day trading, a fair value gap or fair value gaps refer to price gaps that occur when there is a significant imbalance between supply and demand, resulting in sharp move in price with little to no trading activity in between. So these gaps can be seen on a price level as areas where there is a noticeable jump from one price level to another without any trading occurring in the intermediate prices. So here on TradingView, I wrote out 5 principles in order to identify a fair value gap. Starting with number 1, we have the identification of gaps. So fair value gaps are identified by looking at the price action on a chart. They are typically found on higher time frames, for example, daily, hourly, 4-hour, and are marked by a sudden price movement with no overlapping candles. At number 2, we have market imbalance. So a fair value gap indicates a strong imbalance between buyers and sellers. This imbalance suggests that there may be a lack of liquidity in the market at those price levels, causing the price to jump quickly. Number 3 is the potential reversal points. Traders often view fair value gaps as potential reversal points. The idea is that prices may eventually return to these gaps to fill them, meaning that the market may retrace to these levels or zones to find a balance between supply and demand. Number 4, we have entry and exit points. Traders use fair value gaps to determine entry and exit positions for their trades. For example, if a trader identifies a fair value gap below price, they might expect price to eventually make its way back down to that level for potential buying opportunities. And conversely, if a trader identifies a fair value gap above price, they might expect price to eventually drive back up to that area for selling opportunities. And last but not least, we have risk management. When trading fair value gaps, it's important to have a solid risk management strategy in place. This includes setting stop loss orders to limit potential losses if the market does not behave as expected and the gap does not get filled. Just like any other concept, this isn't 100% accurate. It's not going to work all the time. But with that being said, you want to make sure that you have a good risk management strategy so that you're not losing more than your wins. And I made a video about risk management, I believe in week 2. So if you're having a hard time finding a good risk management plan to stick to, I recommend watching that video and taking my advice, okay? But yeah, in general, understanding and effectively utilizing fair value gaps can be an essential part of a day trader's toolkit, helping them identify significant price levels and potential trading opportunities. So one thing I'm going to do a bit differently than my previous videos, instead of looking for examples and then going on visual PDFs, let's start with the visual PDF so you guys have a good idea of how these zones work. So like I mentioned before, your fair value gaps are drawn out where you have a first candle, you have the mother candle, and then you have the third candle where the zone is drawn out from that previous wick to the third one, not engulfing the mother. And then we have the other fair value gap drawn out for bearish candles where you have the first candle, the mother candle, the third candle. And again, the zone is drawn out from wick to wick. All right. And I want you to remember this because there are 3 types of fair value gaps and we're not going to dive too deep into them. I'm going to briefly explain this one because this is the one you'll see the most when price has some sort of imbalance and you're waiting for a retracement. Now, from my understanding, the main point of a fair value gap is to catch potential areas in the market that don't quite make it to your supply and demand zones. Because if you think about it, if you've ever been in a situation where price doesn't quite make it to that supply zone or your demand zone, there's a reason for it, right? Price is stopping at a set location or gap in the market that is being filled. So for example, on this PDF, this might be too small.
Let me zoom in. Hopefully you guys can see this. I might just have to take my face out. But if you can see these red areas in the market that they have marked up, we have one right here, and one right here that we'll talk about. So the first one, notice how if we had a push in the market just like this, we would have drawn out some sort of supply zone at this bullish candle and would have pushed it all the way out to around this area, right? Notice how price pushes down, comes back up, but never taps our demand zone, right? What happens? It stops at a set location in the market. It has a retracement, trails up a little bit, dips, and then pushes through our zone. So our fair value gaps are ensuring that we never miss out on these moves in the market for potential entries. And notice how the gap is drawn from the wick, the first bearish candle, to the third one. Not overlapping this mother candle, simply placing the zone from wick to wick. So they draw the zone out, and what does price do? Comes up, taps that LPI, pushes down, comes back in, hits that 50%, sells again, and then finally has a breakout. They didn't stretch this zone out, but we could say eventually it also has a break and retest to the upside. You guys see this? And then price trails some more, and then what do we have right here? More imbalance. We have this huge impulsive move in the market. We have these nice consecutive bearish candles, and now they're doing the same thing. The first candle, the mother candle, the third candle, wick to wick, not overlapping the middle one right here. They draw the zone out, and again, let's see what happens. Price trails down, it eventually comes back up, taps her fair value gap. A lot of people are hopping in for sales right here at this LPI. Comes back up, nears our HPI, that highest point of interest within the zone, and then a lot of people are hopping in for more sales. So you would have been able to capitalize on more than one potential entry in the market. Now, same thing with this over here. Let's say we were simply trading supply and demand. Well, before we get this push, we have this nice bullish candle where most people will draw their zones from wick to wick, pushing their zone out all the way out here. Now, eventually, price does make its way towards that zone, but it was only for one touch, right? We would not have been able to capitalize on this move because price stops right here, trails down, and then pushes up. So in my opinion, your fair value gaps are going to grant you more opportunities to capitalize on because these gaps that price is reacting off of are in between your supply and demand. Now, the next PDF, I thought about talking about because there are other ways to identify a fair value gap. But I'm not going to dive too deep into it in today's video. I might have to make a separate video on my channel in regard to this series. But same type of concept where price is forming some sort of imbalance and they're simply drawing that zone from the previous wick to the third one, stretching out the zone, and notice how price eventually reacts off of it. Okay. So if we go in the chart, I have some examples. I have about 4 examples that we can talk about today. And this works on all financial instruments, okay? So let's go ahead and start with GBP USD for the Forex traders. Now, this one might be a little tricky because obviously we have a gap right here. But what happens when price isn't at that area, right? Where we can't identify some sort of gap. Well, let's move to the second one, market imbalance. So we have a nice push. Let's just say we're working with supply or support and resistance where we have some sort of imbalance. We have a push. Now, working with this, how can we find a fair value gap? Well, the next one is potential reversal points. So just like the break and retest, when price has a break of structure, taking out this high or this previous high right here, we need to have some sort of retrace to have a continuation. So we have a eye in the market where we can potentially find some sort of fair value gap. Now we want to look for our entry and exit points. So just like the PDF that I shown you guys, we're going to pay attention to 3 consecutive candles, drawing the zone from the previous wick to the third one. So if we scale into that push, that bullish move, let's go ahead and get our rectangle tool, and we're going to simply place our zone from the first wick to the third one, not overlapping the mother or the middle candle. Let's go ahead and draw the zone out. I'm going to push price back a little so this doesn't confuse you guys, because you might be thinking, well, we have more than 4 bullish candles. But again, realistically, if you're trading in the market, my bad. If you're trading in the market and price hasn't printed all this data, let's say price was around this area right here,
this would make much more sense, right? Let's say we get a nice closure like this. Now this makes much more sense because we had 3 candles, we have a nice push to the market, and now we have a clear fair value gap. So let's just go ahead and continue and see what happens. So price does make a wick at that LPI, tapping our zone, making it some reliable entry point. We're going to continue. Notice how it starts to near that zone again. Boom, we get another touch right here. We have potential buyers finding interest for entries. And notice how it doesn't quite tap our newly formed support. Let's see what happens. Okay, so if I were to draw this zone out, what do we notice? Well, price does come back to the zone and makes another touch, hits our 50% level, pushes up for a little bit, finally has a breakthrough out of that fair value gap. But what happens over here? Notice how it comes back up for that 50%. So potential sellers are hopping in for sells. And then it makes a touch at our HPI, the top of that zone, for more potential selling opportunities. And as we continue, price then makes another touch. So this is 1, 2, 3. I'm just highlighting these areas of the market so you guys can see them. We have one right here, and one right here. So you would have been able to capitalize on a lot of selling opportunities instead of just focusing on a vague zone, maybe of supply and demand. Let's say, let's go and delete this. Let's say we're using the concept of supply and demand where we have an obvious area that we know price is eventually going to make its way back to. Let's say we're using this right here where we have a push to the market where we can identify this zone to be some sort of demand. Although price does eventually make its way back down to our 2-hour demand, we would have missed out on several opportunities in the market, which is why I emphasize that fair value gaps grant more opportunities because our fair value gaps are between our supply and demand. Hopefully that makes sense. This can be a bit confusing, which is why I'm going to go over 3 more examples. But this was a great visual representation of why you want to keep an eye out for these gaps in the market in case you want to capitalize on more opportunities. So the next example on S&P. First things first, we want to try to find some sort of push to the market. Let's say we want to look at this move over here. We have these 3 nice consecutive candles. Let's go ahead and get a replay button and go over here. All right, so in S&P, let's say price was present at this time. We have these nice consecutive bullish candles where we clearly have some sort of gap formation in between these candlesticks. So we have the first one, the mother, and the third. Simply going to draw the zone from the previous wick to the top one like this and draw our zone out. And as we continue, let's just observe price action. The price makes a touch already back to that LPI. So a lot of buyers are hopping in for buying opportunities. Let's continue. We have another touch right here at that 50%. People are hopping in for buys. Let's continue. We have another touch at that HPI, that surface level of that gap, where again, we have buyers hopping in. Let's continue. Now, finally, at this area, we get a break out of that zone. So now we want to see if price is going to make its way back to that gap to have a nice bearish continuation. Let's see what happens. Boom, we get that touch at that service level and price drives down. So we have another opportunity where sellers are now in control. Let's continue. Okay, and price decides to drive towards a different range where you would identify another fair value gap. So let's just go ahead and observe this real quick. Notice how we had this nice push to the market. We drew our zone after that imbalance from wick to wick, and we had a touch right here. We had a touch right here. Price finally broke through our zone where it also respected that break and retest for selling opportunities. So you would have been able to capitalize on 1, 2, 3, 4, 5. about 5 moves in the market rather than with supply and demand, where you would have had your zone at around this area before getting that push to the market. And then you would have had another zone above this accumulation at around what? This area, right? Or let me go ahead and scale in so I can find this more accurately, or scale up. Let's go on the 4 hour. I don't even know where I would draw my supply zone, to be honest with you. This is more of a trend or a wedge. But my point being is that you would have missed out on several opportunities because you're waiting for price to reach a certain area instead of just seeing where price is at, where you have a potential gap in the market that price is reacting off of. This is why, in my opinion, I think fair value gaps are the most beneficial for not only beginners, but more advanced traders if they want to scale up throughout the week to reach that 10% goal. Instead of waiting and waiting and waiting, you're going to be able to find more moves in the market off of respected price action. So our next example is on T-bond futures. I did say I didn't want to talk about the second example, but it is pretty self-explanatory in terms of the second type of fair value gap. If we go to this PDF right here, I kind of have it drawn out where you have the first candle, you have the second candle, and you have the third one, but the first one isn't necessarily a bullish candle. Why? Because we get that push in the market, we get that imbalance, but notice how if we were to use these consecutive candles, this one being our first one, this one being our middle one, and this one being our third one, these wicks overlap each other. Now, this is really important. In order to draw out a valid fair value gap, the wicks cannot overlap each other. So if you have a wick right here, and then you have the mother candle, but then you have the wick pushing through that previous one, it's not valid. There has to be some sort of space, AKA gap, in order to have a valid setup, okay? So notice how they draw it from the previous one to the third one, and they still draw it out, and price eventually reacts off of that gap. Now, going back on TradingView, if we work with T-bonds, and let's just say we're working with this area right here where we have an impulsive push in the market, and let's go ahead and scale on the 1 hour. So notice how we have some sort of imbalance forming because we have a break right here, and now we're trying to look for some sort of retracement. Well, our fair value gap would have been drawn out from that previous bullish candle before getting that push to the market to the third one where it stops or where it ends. So I would take my zone, place it from this wick to this one right here, and simply extend the zone. Now, if we get the replay button and see this in real time, you'll notice that price opens up on Monday, pushes outside of that zone just a little bit, not quite, doesn't close above, so it's still valid. We have a push, and now we're waiting for a retracement back to that zone for some sort of sell continuation. Price hits our LPI. A lot of people are hopping in for sells right here. Let's continue. Okay, so price doesn't make its way back up for a second touch, but you still would have been able to capitalize on some sort of sell entry. I guess this isn't the best example because we do have a lot of consolidation where price could potentially fake you out right here, but this is still a valid fair value gap setup. If this is still confusing, because I'm not gonna lie, it took me a few days to really grasp the concept of fair value gaps and really understand the importance of this concept. So if you're still confused, I'll leave the link in the description to the ICT video that helped me really understand this concept. So I want you to watch this video again, try to grasp a solid understanding of fair value gaps. And then for homework, what I want you guys to do is identify these zones, not comparing them to supply and demand, okay? Because supply and demand is much more simple. You're finding that push the market, and before that push or traffic, you're just drawing that zone from the previous candlestick.